Includes access to modified vaccines if they're needed to combat Omicron and other variants. It's a big win for Moderna, which will supply 60 million of the shots. That's more than 3 times the total of its existing contract with the UK. And the US restrictions on travel from southern Africa due to the Omicron variant will be temporary. That's according to President Biden's chief medical advisor, Dr. Anthony Fauci, who spoke after health officials identified the first US case of the variant. Fauci says the ban won't prevent infected people from arriving, but it will give authorities some time to prepare. Democrats could get a powerful campaign tool for 2022 elections if the Supreme Court rolls back abortion rights. The court's conservative majority signaled there could be a major shift during arguments Wednesday over a Mississippi abortion law. Democratic strategists say that if that happens, it would spur their base voters to turn out, whilst taking swing voters away from Republicans. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now. Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Crypto, you have a world of young people that want their own financial system. and their own culture. And it is very powerful, and I'm a big believer in it.
There are some additional mutations, but the clinical significance of those mutations is unknown. So I think we really have to wait for the data, and I don't expect that there is a significant drop. If there is a significant drop, then Pfizer has a playbook to develop a new vaccine.
That was the Pfizer VP for vaccines for international developed markets. And can I just say, Tom, there seems to be some daylight between how Pfizer communicated this week and how Moderna and the leader of Moderna chose to communicate earlier this week with the FT.
I don't disagree with that. And both of them, I'm sure, are treading lightly here. They have a corporate effort to win, but also just given the waiting, John, I think is the key thing here, the waiting that we're doing on December 2nd.
And we keep waiting for that data. Tom Keene, Lisa Brabbett and Jonathan Ferro from New York. Your equity market's up 28, advancing 0.6%. Yields bounced back 3 basis points to 143.92 on 10s. Bit of good news out of Glaxo. GlaxoSmithKline saying its COVID-19 antibody treatment looks to be effective against the new Omicron variant in early testing, going against something we heard from Regeneron Pharmaceuticals earlier this week, Tom. So, bit of decent news out of Glaxo in the past 24 hours.
If you want to speak on South Africa, as we are all thinking about South Africa and the fears that we face, maybe it is good to speak to the Desmond Tutu professor at Johns Hopkins University. Christopher Byer is one of the great international students of virology and these horrific pandemic diseases that we see. Dr. Breyer, when you heard of Omicron and you dovetail it with the phrase South Africa, how did you respond?
Well, of course, we're very concerned because the area where the Omicron virus is spreading the most, which is Gauteng province, where Johannesburg and Pretoria are, and the surrounding provinces, just got through a very severe wave of Delta. They had a Delta surge from July to September of this last year. So you would expect that this is a highly immune population. More than 70% of adults had COVID during this surge, and yet the virus is spreading very quickly. So that raises alarms.
Dr. Breyer, I take great issue with a media and a non-science media that think this is an episode of ER, or even to look back farther, Dr. Kildare, where everything's going to get wrapped up at the end of the hour. That's not the case. It's about serious science, as you mentioned in our opening discussion, of neutralization of the virus, of a study of antibodies, and particularly the difficulties of serum dilution. Explain what's going on in the lab right now to help us.
Well, what we're mostly looking at right now is trying to understand if people who have good neutralizing antibodies, so people who have recovered, been immunized, if their sera is able to neutralize this Omicron variant. We're trying to understand the level of vaccine protection that we may have. And the strong suggestion really is that there may be a dilution, there may be a diminution in immune response, and that's why the message is coming out about the importance of boosting to get that immune response back up to protective levels. So right now we have an advisory for everybody who's eligible in the United States to get boosted, and I think that's the most prudent thing to do.
Dr. Byer, that's exactly where I wanted to go. Before this Omicron variant came to the fore, there was a lot of disagreement on who should get the booster, how important it was to boost immunity, and now it's basically one of the basic measures that's being hawked. How much of the science has changed versus just trying to throw everything we've got to prevent another wave?
Well, I think there wasn't a scientific consensus, and there is now a pretty strong one. And I think what has changed is, first of all, the reality that this virus is circulating in a population that is highly immune. So that is, of course, a real concern. It's also the case that South Africa has been using Pfizer. They have been using mRNA vaccines, and yet this virus is spreading. Now, the good news is that, at least for the preliminary data we've seen so far, which the South Africans have been great about sharing, I must say, is that people who are fully immunized appear not to be going to the hospital. But it's early days. So we're going to have to follow that. We're going to have to see, as we've all seen over the last year and a half, the waves of hospitalization and severe disease have a time lag from when these variants start circulating. So the jury is somewhat out on that, but nevertheless, it does look like vaccine protection is holding and boosting is the right way to bump it up.
Which perhaps is the reason, given the fact that vaccines are preventing some of the severe illness, that you have the likes of many European countries putting into place vaccine mandates. Angela Merkel of Germany saying there's going to be a lockdown for the unvaccinated. A number of nations coming out with fines. Do you have a sense scientifically of whether this actually increases resistance to getting vaccinated or actually gets more of the population inoculated?
Well, the evidence is pretty clear that mandates work. One part of that is behavioral. It seems to be that when the decision is sort of off somebody's chest, the resistance in at least some people does decline. We also know that vaccine mandates are constitutional in the United States since 1905, since Jacobson versus Massachusetts in a case of smallpox outbreak. So vaccine mandates, I think, have a very important role to play.
Dr. Breyer, one final question. This comes in airmail from Geneva, New York. The people at Hobart and William and Smith want to know if the cold of Geneva, New York, coldest place on the planet, if the cold of Geneva, New York will kill COVID. What do you think?
The bad news is that cold weather drives people indoors, and what we've seen consistently is rising rates. Of course, that's why Europe is in the middle of their fourth wave in the winter. And as a Hobart alum, I can tell you, it felt like, going to college in the Ice Age.
It is. Thank you so much, Dr. Breyer. John Farrell, I can tell you that Hamilton, New York and Geneva, New York vie every year in hockey for the two coldest places on the planet. John, I saw a puck break in two at Hamilton, New York once.
And that's why every time I say it's winter, it's cold outside, you turn around to me and say,
you have no idea.
You don't know what you're talking about.
Dr. Breyer knows. He is one of the giants of Hobart and William and Smith.
There's a damp in the UK cold, though, Tom. There's a damp that just gets in your bones, and it's not nice.
Like
you found
Fargo.
that. It's a different kind of cold.
Give me a break. 30 degrees below zero in Fargo.
There we
damp.
go.
It's
Don't
a little
get Lisa
damp.
started. Lisa, we just, it's still early. It's still early.
I know.
Deep breath.
Unfortunately, Lisa's right. It's colder in Fargo.
Thank you, Tom.
Lisa Brown is getting frustrated with Tom Keane early in this program. There's two more hours still to go. Futures up 28 on the S&P,
excited?
up 0.6%. I'll try and stir the pot as we go along.
Oh, I'm sure.
In your bond market, yields are higher by 3 basis points on 10s to 143.75. We're setting up for jobless claims at 8:30 Eastern time, and then we've got payrolls tomorrow. And ISM in the rear view mirror in the last 24 hours. I have to say, the ISM, Lisa, was pretty decent.
Yeah, it was pretty decent.
shock.
You didn't see that many super serious complaints about supply chain disruptions.
More still to come on this program on that and on this bond market. We'll catch up with Sabahat Rajappa, the head of US rate strategy at Societe Generale. Looking forward to doing that in just a moment. SocGen on the bond market on their rate call as the spread on Wall Street starts to come in a little bit for June, July, May next year. And then you've got these outliers. The people willing to wait, the Morgan Stanleys, the TDs, just setting the scene for 2022. Lisa says for now. From New York, this is Bloomberg.
101 years ago, Ewan Dixon was the first guy to do it. It's taken a century for us to change our propulsion system away from liquid fuels.
There are dozens of international companies in that airframe size who have realised the opportunity, are in a race to get those commercial aircraft out there at that scale. It's an area that can be served by hydrogen, which we're well placed with, through fuel cells.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation. And we believe that the Q3 was the quarter that was most affected.
The Fed is already behind the curve. Everything they're saying in the last month points to them getting much more serious on inflation.
We might even see core inflation at, I don't know, 6.5% potentially in February.
They're going to start that journey to normal, and we're going to help them on that path.
The market is really starting to position itself for a little bit more normalization.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
We are getting an avalanche of rate hike calls this week from New York City. For our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market up 28, advancing 0.6% on the S&P 500. TK, you've seen the calls. Rate hikes for 22, rate hikes for 22.
Yeah, we went through it. You know, I'm going to wait for the data to come in. We got Brazil right out. I'm looking over here at the wall of information we've got in the zeitgeist. You know what? Brazil's going to come out with data. Turkey's going to come out with data, and the U.S., John, is going to come out with data like at 8:30 today, and we're all going to massage it and move forward. John, the market's up.
The market's up, and the Fed's looking forward, Tom, and saying, we don't know. And so many other people don't know. Yet, Lisa, they are willing to say 2022, liftoff is just around a corner, and some.
Well, and Jay Powell basically gave them that signal when he talked about accelerating the taper. And we talked about the importance of fighting inflation. This was a game changer. The interesting thing is, as Tom said, John, the market's up. We're not seeing a tightening in financial conditions, even as you start to see people pricing in 2 and even 3 rate hikes for 2022.
The equity market's bounced for now, but look at the bond market. The move that we've seen in the 30-year yield over the last 12 months, the optimism of Q1, and then we look at Q4 and roll over.
John, I'm going to talk about here the duration. You can learn a lot. Everybody's short-term, 2 years where the Fed is. I get that. You learn a lot from the 30-year, and critically, John, through the week, the 30-year has come in a little bit more to 1.77%. It was at 2%, what, 2 cups of coffee ago?
2's up, 30's down. Lisa, that curve's flatter.
The issue to me is this significant in terms of a recession or predictor that, therefore? I mean, people say that this is typically the most reliable indicator of some sort of downturn, but we are years away from that. Jim Reed of Deutsche Bank was saying that typically it's 18 months after inversion, and we're probably a year or 2 away from inversion. So for now, does it really matter?
Do you think they want to hike if this is the direction of travel? on that yield curve.
Do you think that it really matters? I mean, Bob Michael of JP Morgan yesterday was saying that this is just people washing out of their positions. It's not actually an indication of slower growth. But right now, the balance of risks with inflation is perhaps necessitating them to move because otherwise the market will do it for them.
John, that's the smartest comment. I hate to say this, Lisa. It's the smartest comment I've heard today, which is this idea of don't underestimate washing out of positions. I think that's important.
Year end, still a month to go. Yields higher by 3 or 4 basis points on 10s. Yields up to 144. Let's work through the price action. Your equity market, futures up 31, advancing 0.7%. Equities pushing higher on the S&P 500. Into the FX market, euro dollar 113.37, and in commodities, crude up 1.25%. Lisa, 66 on WTI.
Man, the round trip in oil has really been jarring. All right, today at 8:30 a.m. we get U.S. initial jobless claims. The expectation is for us not to see a repeat of last week's 199,000 claims. That was the lowest number of people filing for jobless benefits going back to 1969. It's expected to rise a bit, but here's my key question for the Federal Reserve. What is the threshold? How good does the job market have to be for them to go forward versus really just focus on an inclusive labor market recovery? How much is inflation really sucking the oxygen out of the room? Today, we're talking about oil. OPEC Plus is wrapping up a second day of talks talking about potential output for January. Nice. The plan was to increase it. Will they continue to do that, given the fact that people are now worried about Omicron? Will they continue to do that, given that the price of oil has declined by more than 20% since late October? And will they do that if they know that President Biden is desperately hoping that they increase production? He is still planning to release oil from the strategic petroleum reserves despite the fall in prices. And then at 1:40 p.m., President Biden is planning to speak on those latest steps to fight COVID-19. What's he going to say? How is he going to position this? He wants to get more people vaccinated. He wants to tell people to be more cautious, but we are exhausted. People have pandemic fatigue in a real way. How does he avoid a surge in the winter at a time when this really does hinge on an economic recovery that his re-election and, frankly, the midterm elections next year do hinge upon?
Lisa, I'm with you. I'm with you. More on that a little bit later. More on this now. Apple, negative 2.3% in the pre-market. Great reporting from the team at Bloomberg, Tom. The company has told its component suppliers that demand for the iPhone 13 lineup has weakened. This according to people familiar with the matter. We're down 2.34% to 160, Tom, 160.91.
I don't have any wisdom on this, John, other than to remind on profitability and use of cash that Apple is still being modeled with $100 billion in free cash flow off the Bloomberg terminal. That's like, I don't even know how to grasp that, John. That's such a big number.
160 in the price right now. 200 the call from Dan Ives at Wedbush. There's some bulls out there still, 200 at Wedbush. It's very interesting, Lisa, to see how consumers could respond to supply constraints, not just against higher prices, but just availability. If you haven't got it ready, I don't want to know. I'm not going to buy it.
I wonder if we can really extrapolate out, though, from this Apple story, because part of it is that the 13 model was not that different from the 12 model, and they are going to have a more updated version in 2022. So if it takes long enough, people are just going to wait that extra couple of months for the next version. How much is this people just getting sick of waiting for one iteration versus trying to get the upgrade?
Or as Matt Miller said, they just don't like it.
Yeah, that's also true.
Always making up excuses for Apple, but maybe, Tom, they just don't like the phone.
I'm still paying for Afterthoughts lost AirPod thingy, the white thing that goes in your ears.
Apparently the kids are going back to the wired headphones, Tom.
Oh, we are. Yes, we are.
That's a theme.
Yes, it's a theme. We are doing that. Vetville's got a set now. It's great.
That's how you look cool. You go back to the okay.
You got to have the little dingy dongy thing, and it's got to be the right one.
Fashion updates with TK and Ferro. That's what people tuned in for, wasn't it? Subhadra Rajappa joins us now.
That's it.
US rate strategy head at SocGen. Subhadra, we'll start with this bond market. We won't do fashion. Let's start with 2s, 10s, 2s, 30s. Take your pick. The curve's flatter, Subhadra. What's your message for clients at the moment?
I think the messaging from the curve is very, very, pessimistic, if you will. I think that the market, generally speaking, seems to be holding up fine. Financial conditions are still accommodative. Equities are doing okay. But the yield curve flattening as much as it has is somewhat troubling. And like you pointed out earlier on in the segment, John, it's about where do we go from here? This is where we're starting from. And if the Fed's about to deliver maybe 4 or 5 hikes in the next couple of years, what happens to the curve? And will the Fed actually allow the curve to flatten out too much and, policy ultimately lead to a recession. That's really where I'm kind of struggling with how flat the curve is. And to me, I feel like the Fed is not going to allow the curve to flatten too much and tighten policy that way.
Subhadra, you say it's concerning. What do you do with the flattening yield curve? I mean, do you take down risk, or do you just say this is something to watch to get a sense of the trajectory, perhaps, of Fed policy?
Well, I think a lot of this might be position unwinds and things like that. But broadly speaking, you've got to kind of ask yourself, why are you in Treasury bonds at 10-year yields around 140 or 145, right? To me, it just doesn't make a whole lot of sense when you're consistently getting negative 1% returns to hold on to Treasuries. It's not, a 60-40 portfolio. You don't see that sort of offset anymore with equities. So it really doesn't make a lot of sense to, sort of plow money into Treasuries at these yield levels.
Subhadra, your company, for decades, I want to say centuries, owns a high ground on derivative math. Where is the derivative opportunity now in fixed income?
Well, I think investors have broadly been very, very careful. Implied volatility has been very high. Typically in the past, you've seen investors come in and sell volatility and sort of, earn extra carry by way of short vol strategies. But right now, I think everybody's kind of scared. They just don't know how things are going to go. And if anything, if you look at the vol market and you try to extrapolate sort of the path of where 10-year yields could be a year from now, it's saying it could be anywhere between 270 on the upside and 1% on the downside. So there's an extremely wide band of probabilities of where things could go from here on. And I think that investors, broadly speaking, are very cautious.
Subhadra, I just want to wrap things up here because we're getting a ton of questions on this from audience members. There is a difference when someone speaks for themselves in a speech, when they speak for the committee in a Fed News conference, and when they provide testimony to Congress. Do you think that's what shaped things perhaps this week for the Fed chair, that the audience was an audience of politicians, the people that are going to renominate him?
Well, his audience is always the world, right? Because everybody is listening to every word that he's saying. It's a good thing that he's already gotten a nod for a renomination from the Biden administration. So I don't think he's going to have much of an issue on that. I think he really wanted to focus on messaging, sort of jettisoning, if you will, the transition or I should say transient nature of inflation argument, and then sort of focusing much more on perhaps speeding up tapering. So I think that that's the message he really wanted to get out in the testimony. I don't think he's really that concerned about getting, renominated or any of that, because I think that broadly speaking, he wants to tee the markets up for the December meeting so that any sort of a change in the taper announcement is not a surprise.
Well, he's done that in a big way this week, that's for sure. Subhadra, thank you. As always, Subhadra Rajappa there of SocGen. Elisa, I asked that question because we have these smart conversations on programs like this, and then you get these messages from other people who say, you know what, this is what I want to know. What's behind this? And of course, you never know what an individual is thinking, and I don't want to get into the business of trying to work that out.
There are certainly, I don't want to say conspiracy theories, but the sort of skepticism of a sudden pivot. And there is a question about why the pivot was done so quickly. Nonetheless, the data does seem to support, and frankly, economists as well have been talking about inflation. It's not going to die down so quickly.
The additional piece I'd add into that as well, Lisa, is it's not just the Fed chair. It's not just the Fed chair saying this, Tom.
Exactly.
There's a lot on the committee now, singing from the same hymn sheet.
I'm glad you guys carried that interview forward, because the afterthought was coming back and forth. John, it's this. Santa's looking for this. The cost drop Porta Pro X headphone.
How much
John,
are they?
You need it. I don't know.
The shopping channel?
They're sold out worldwide. John, you would look so good in that.
What are they, Tom? They look dreadful.
Are you dressing him?
I don't know. This is what the kids want.
Look, I tell you what, if this is the shopping channel, I'm not selling. I'm not selling those.
This is a
I
new
am not
game
selling
show.
those. I care about our audience members. What are they, TK? What's the cable about? What's the band around the top?
You gotta have this.
I'll take a pass from New York City. This is Bloomberg.
Must have.
With the First Word News, I'm Ritika Gupta. Apple has a problem it wasn't expecting with the iPhone 13. Bloomberg's learned the company has told suppliers that demand for its newest device has weakened. It's a signal that some consumers have decided against trying to get the hard-to-find item. Apple already has cut its iPhone 13 production goal because of a lack of parts. 5 months ago, President Biden declared the U.S. was on the verge of defeating the coronavirus. Now the virus is threatening a resurgence across the country, and the Omicron variant has been detected. Today, the president will lay out his latest plan to quell the pandemic that has dogged his time in office. It will include stricter testing for travelers from abroad and extending a mask mandate. The U.S. government has moved another day closer to a brief weekend shutdown. Congressional Democrats and Republicans are still trying to reach an agreement to pass a temporary spending bill before Friday's deadline. Senate leaders haven't been able to turn back a threat by conservative Republicans to tie up the vote over their objections to federal vaccine and testing mandates. And the Turkish lira is trading near a record low again after President Erdogan fired the country's finance minister. There's been an ongoing fight over monetary policy in Turkey. Erdogan wants lower interest rates to spur growth. That's led to the currency to collapse and inflation to surge. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Reducing global warming continues to be an uphill battle in the fight against climate change. 1.5 degrees Celsius. That's the temperature deemed the safe limit for global warming set by the Paris Agreement in 2015. To limit warming to 1.5 degrees Celsius, CO2 emissions would need to be reduced by 45% by 2030. 191 Paris Agreement signatories committed to setting national targets to reduce CO2. But current national targets project a 16% increase in greenhouse gas emissions by 2030, with global temperatures expected to rise to 2.7 degrees Celsius by the year 2100. Among the most vulnerable to global warming are many of the world's smallest and poorest countries.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time?
What did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I had no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
How does an extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of health care, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The U.S. needs to get back on a sustainable fiscal path. The right time to do that is when the economy is strong, when the taxes are rolling in, when employment is high. I would say that the inflation that we're seeing is still clearly connected to pandemic-related factors. I would also add, though, that it has spread more broadly in the economy, and I think that the risk of persistent higher inflation has clearly risen.
Fed Chair Jay Powell, inflation is broader, it's stickier, and we need to adapt, and that's what we're doing. Equity futures are positive 16 on the S&P. We fade just a little bit on the S&P 500. We're positive 0.4%. NASDAQ futures are down about 0.1%. Yields are higher, but they fade a bit too, up 3 basis points on 10s to 143.58. And speaking of fade, switch up the board and get intraday stock 600 up quickly. Over in Europe,
John.
Session lows. We're negative 1.5%. Worth pointing out that Europe was closed when we started to slide a little bit more late in the session stateside yesterday. So that's some of the losses this morning. But add to that, Tom, session lows, and we roll over a bit on the S&P too.
John, for our American listeners and viewers, how devoid of technology is the Stocks Europe 600?
The beauty of the Bloomberg terminal, Tom, is I can give you the weightings just like that.
Well, but you know, you've lived it.
I will go to the sector weighting for you, though, just to give you the precise weightings on a stock 600. Healthcare is about 15%, Tom. Industrials is about 13%. Technology right now is about 7.5%.
That's amazing.
If I switch that up for you and get you the S&P 500,
well, you're going to use the Dow.
Again, I'll get you the weightings are not on an individual name basis, but on a sector basis. 29% information technology compared to 37 over on the stock 600.
That speaks volumes, doesn't it?
And that's the issue right now. And that's why we can always say there's a valuation spread between Europe and the United States. It's been that way, Tom, for a long time.
Maybe if you're a Syrian and you come over here and you float along and you fail, you succeed, you fail, and then Mr. Jobs will start a small company like Apple. I hereby declare on oath that I absolutely and entirely renounce and abjure all allegiance and fidelity to any foreign prince, potentate, state, or sovereignty, and that is the oath to become a U.S. citizen, and we're thrilled. KB became a U.S. citizen yesterday. Emily Wilkins, this speaks to all at Bloomberg, as well as this nation. On the immigration debate, where does that sit right now in Washington?
So the hot news on immigration is all wrapped up in that social welfare and tax plan, the so-called Build Back Better. The Democrats have been pushing to get something, anything on immigration into that package. They have promised to deliver on it. Progressives have pushed for it. They know it's important for Hispanic and Latino voters. But the fact of the matter is, Tom, is that the reconciliation, not everything can go through that process. It has to be stuff that really directly relates to federal revenue and federal spending. And a lot of proposals on immigration don't have that direct connection. It's more of an indirect thing. So lots of discussion and debate right now about what, if anything, can be included on that. But that's really about the only momentum we have. I mean, it's a very partisan issue. It's something Congress really hasn't delved into since 2013. And there's no signs that there's the momentum to really do anything big on it besides whatever small thing can go into this larger package.
Not to catch you unawares and unbriefed on this, Emily, but it's a fair question, I think, to say, where do we stand on the importing of professionals like at Bloomberg, KB, and like others across all of Bloomberg, including our computer people as well? Where do we stand on that dynamic that Microsoft needs immigrants?
You know, it's really interesting, Tom, because if you delve into immigration policy, there's actually a lot of bipartisan consensus. There is a sense that the U.S. does need to be attracting top talent. There's also a sense that the U.S. needs to make sure that we can get the workers up there in Maine to harvest lobster, the workers in the farmlands across the U.S. to be able to harvest, to make sure that they've got the workers there. A large of it is a lot of question on exactly how to do it, and a lot of it also gets stuck in that question of citizenship. Now, obviously, obviously, citizenship not necessarily needed for someone to come and legally work in the U.S., but there is a sense that if you're going to do something on immigration, going to pass one provision, you need to try and get as much as you can on there. This is one of the larger issues right now that Washington is really struggling with, the inability for doing smaller bipartisan changes, because everyone wants to add more and more and more to a package, because there's a sense that so few things actually get to the president's desk and signed into law that anything that has momentum is immediately weighed down with a bunch of other priorities.
Let's talk then shorter term. Let's talk about some of the travel restrictions that we see and the uncertainty going forward about what the travel restrictions may be. A friend of mine is going home to Nigeria, doesn't know if they'll be able to come back since it's unclear what the restrictions will be in a month or 2 months, whether there will be a quarantine period. What is the sense about a tolerance for additional quarantines, additional restrictions, and the political ramifications of doing so on both sides of the aisle?
So we're going to hear President Joe Biden obviously address this a little bit later today. His administration has been working on sort of their next step for the administration's response to COVID, what that's exactly going to look like. We aren't seeing at this point any quarantine for travelers. I mean, obviously things are fluid. It could shift as we learn more about the Omicron variant and what that means. But at this point, we're going to see the changes are actually really more directed toward keeping the economy and society open. There's going to be something that's going to be put out today, that CDC guidance that could potentially allow students to stay in schools even if they have been exposed to the coronavirus. There's also discussion about how to make sure that workforces and workers are able to be on the job and that the economy can really keep going. I mean, we are still going to see things like mask mandates, booster shots for all Americans. The Biden administration is continuing to push those things. But if you look at comprehensively what they're going to be coming out with today, it really does speak to the fact that the Biden administration is very well aware that Americans want the economy to reopen, that they want to put the pandemic behind them, and trying to figure out the rules and processes that need to be in place for that to happen.
Emily, thank you. As always, down in D.C., Emily Wilkins. There's a big difference between what we might hear a little bit later from the administration and what we're seeing play out in Europe right now, point one. And point two, when it comes to travel, Lisa, the African nations are a separate issue right now. It's an important one. But for the rest of the world, this is about stricter testing right now. And I think the additional thing that was in the Washington Post earlier this week in the story was that whether we would have this additional 5 to 8 day quarantine being introduced. And I haven't heard that just yet. And I think for the airlines, what we've been talking about, what would be critical to them, if you turned around and said 5 to 8 day quarantine, the airlines are going to struggle with that going into the holiday season. Increased testing, 24 hours a single day, that won't be a big deal.
No, and that seems to be the balance in terms of the mood in the United States. It is different in Europe. It is different in places like Portugal, which has upwards of 80% vaccination rate and yet is implementing a lot of pretty strict lockdown types of measures. You do wonder whether the threshold will become more unified on a global sense, giving some sense of order to airlines and to people who are trying to travel around the world.
Going to run you through the price action briefly. Up 16, call it 17 on the S&P 500, advancing about 0.4%. We fade a little bit this morning, much more so over in Europe. We're negative about 1.5% on a stock 600. Yields fade a little bit too on 10s, up 3 basis points on a 10-year to 143. 143 on 10s this morning, Tom.
Yeah, and John, as I mentioned earlier, I don't want to beat it to death, but I'm sorry, the 30-year bond speaks volumes. It's been, to me, the item of the week.
Near the lows of the year. From New York City this morning, you are watching Bloomberg Surveillance on TV. You are listening to it on Bloomberg Radio. Don't forget, we're live on SiriusXM channel 119. From New York City, alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. This is Bloomberg.
what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that, as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
The October jobs report beat expectations for job creation.
We're experiencing the strongest economic recovery in the world.
Will we get another great jobs report for the holidays? Find out Friday on Bloomberg Television and Radio.
60 minutes ago, I said I've got no idea what's going on. I'm pleased I said that because this equity market has faded once again. Equity futures up 11, up just 0.2%. Nasdaq futures lower, negative 0.2%, and Russell futures well off session highs, still positive by 0.7%. We've been putting together all of the stuff about the Omicron variant, but also trying to discuss what's going on with the Federal Reserve. There's a lot taking place over the last week. There's a lot of factors behind some of the price actions, some of the moves we've seen. So let's go to the bond market and look at 2s, 10s, and 30s, and start at the front end, and then we'll play with the long end too and talk about the yield curve. 2s are just short of where they were last week at 65 basis points. That was the high for the year. 59 basis points right now, 0.5929%. And here's the spread at the moment for the rate hike calls. Barclays go to May. They look for 3 next year, 3 hikes. They look for 4 in 2023. And all the way out in 2023 is Morgan Stanley saying, wait, patience, Q1 23. So that's the spread right now. And most of Wall Street is in and around May, June, July, summertime for that liftoff of the Federal Reserve. What I think is going to be more important, though, as we get into next year, is to work out not when liftoff is, but what the rate path looks like from there onwards. Can we get that steepness? Do we need that steepness? Do they need to do more? Which is the argument of the former New York Fed President Bill Dudley, that they will have to, because rates right now are so deeply negative on a real basis. So that's the 2-year sorted out. A little bit of discussion anyway. Let's talk about the yield curve. 2s, 10s coming into this year, 79 basis points. Then we started to steepen out as we priced in that positive demand shock. It was all about growth, all that enthusiasm about the year ahead. The curve was steeper, steeper, steeper into the end of Q1 and then totally rolled over. And Tom, now we're staring down the barrel at the flattest levels of the year so far. This curve is flatter. If you're the Federal Reserve right now and you're thinking about making a move next year, or at least retaining that optionality, how keen will you be to make a move with a yield curve that's heading in this direction?
I would suggest, John, there are PhDs at the Fed as well that are talking about oil. We're going to get to that in a moment. I'm sorry, John. It's acute. These uncertainties are huge, and they fold into the shape of that curve.
Yeah, and it folds into the estimates we're looking at tomorrow. In about an hour from now, we'll talk about the labor market when we get jobless claims. Look ahead to payrolls. We keep talking about that range. 800,000, the estimate at the high end.
Yeah.
South of 400. At the low end. We'll get to that in a moment. Your yield curve, flatter, 83 basis points, the difference between a 2-year yield and a 10-year yield. That is the cross-asset price action. Let's get you some single names, some movers this morning, and say good morning to Katie Lyons. Morning, Kaylee.
Good morning, John. Well, you mentioned that NASDAQ futures are lower, and a massive part of that equation is one big heavyweight, and that is Apple. Bloomberg reporting overnight that Apple has told its suppliers demand for the iPhone 13 is waning. We already know that Apple had cut its production targets for that new iPhone because of supply-side challenges for this year. They were hoping to make up for that next year. That may not happen. People may be waiting for the model year after that. As a result, Apple is down the better part of 3% in early hours, and some of its suppliers all down in the range of 2 to 3% as well. Qorvo, Skyworks, Qualcomm, all under pressure before the opening bell. As for some other stories to watch this morning, Snowflake is a big mover to the upside. The cloud software company actually reported after the bell yesterday, gave a really bullish forecast, and as a result, that stock is up about 13%. Boeing is higher. This is a 737 MAX story. China saying it is airworthy, poising it for a return to the skies there. That's up the better part of 5%. Vir Biotechnology is also higher. It's a co-developer of GlaxoSmithKline's COVID-19 antibody treatment that we got news overnight. Actually looks like it will work against the Omicron variant. So it's up 16% before the bell, but a COVID-19 vaccine maker, not so lucky, Tom. Moderna looks like it will be down for a third day. It's already down 16% in the last 2 days, lower by another 3% in early hours this morning.
VIX backing up 28 to 29.90. Kaylee Lyons, thank you so much. If you are part of Global Wall Street on radio and television this morning, this is not only the interview of the day, but I'm sorry, maybe it's the interview of 2021. Long ago and far away at Deutsche Bank, Adam Szymanski had a team to dream of on hydrocarbons. They were read cover to cover worldwide. Christian Malik, part of that team, and he is now at JP Morgan, where he has a 32-page PowerPoint migrating base case oil out to 80 with possibilities out to well over $100 a barrel and even out to $150 a barrel. Off the JP Morgan London desk, he joins us this morning. Christian, within all the hyper detail of your wonderful report is the idea that United States shale production will not come on. Boy, do a lot of people disagree with you. Why are you skeptical shale will produce at $100 a barrel?
Rob, Paul, thank you for your kind comments. And I think, shale is in a straitjacket. That's the best way to explain it. The straitjacket is they've got to pay dividends, they've got to pay their debt down, and they've got to decarbonize. When you layer all this on, we can talk economics, $25 to $40 all day long, but the reality is the fiscal baggage on top of that, related in part to transition, related in part to what I call the black premium, which is I'm a shale oil company. I've got to give way more cash back now than I ever had to because my investors only own me for that reason. When you put that all together, you're clearing $75 to $80 at least before you're able to qualify to invest and grow your capex once again. 3 years ago, that was down at 40, 50. So things have fundamentally changed, particularly in the context of this energy transition. It does apply to shale, not just the majors.
Let's not bury the lead here, Christian. This note earlier this week, 150 on Brent. Let's go there. OPEC, you say, show me the barrels. Walk us through it.
Reminds me when I said $30 back in 2014. And I think ultimately what we have now here is this mirage of spare capacity. I love today's headlines. Are they going to add 400? Are they going to add 250? And we can debate this all day long. The question people are asking is, what do they actually have over the medium term? And we've been running this super cycle thesis from the spring of last year when all went negative, and it was almost right in front of us. We didn't see it, which was actually we're obsessed with underinvestment with the majors. What about OPEC? You've got fiscal problems, you've got reservoir issues, you've got supply chain issues. You throw that all together, and our spec capacity analysis comes out as half what the market deems it to be at around 5 million barrels. And what does that actually mean? Well, it means that we don't think we can actually clear 250,000 up to that amount by the second half of next year. And so when you run that analysis, you're getting to around $115, $120. But then if you fast forward in that scenario, come 18 months, there is this kind of sort of like the penny dropping moment in the market, which is, oh my God, these guys don't have the spare capacity. And when we've gone and looked at 40 years of history around when has spare capacity been single digits as a percentage of total capacity, that's when the risk premium shoots up $20, $30. And that's how you get to 150. Your fundamentals are saying around 120. And then it's the market saying, we've got no cushion here anymore.
Christian, I just want to go through these numbers with you so our audience can really get their hands around them, because that's what separates you and the crowd right now. For OPEC spare capacity, you're at 2 million. Consensus is at 4.8. That's a 2.8 million spread. Christian, can you walk me through the numbers, how you got to 2 and why you think everyone else is all the way up there by 5?
It's basically, we've gone through the West African countries, we've gone through GCC countries, and what we're looking at is not the oil in the ground. We're looking at two things: how they finance the oil production effectively as what we call the spare capacity, and two, where the logistics supply chain are and whether it's conducive for them to be able to do it. And when we look at this, we sort of break it into sort of high risk, medium risk, and low risk countries. High risk countries, you've got Iran, Libya, Nigeria, Angola. I mean, I love everyone sort of threatening around Iran sanctions. Again, remove the sanctions. Let's see what you've got in terms of actual barrels. And we think they don't actually have more than 300, 400,000 barrels in addition to where they already are at the moment. And then we move to the medium risk, and believe it or not, Russia's in that camp. Because they've had reservoir problems, they've had to deliver storage into their own inventories, and equally they've underinvested, and they can't add quickly enough because it will hurt their reservoirs. And then you have the low-risk countries like Saudi and the UAE, which have been investing in their spare capacity over the past 3 years, and therefore, as and when demand calls for it, they will be able to deliver. So we're actually at 2.8 million barrels of spare capacity. The market's somewhere around 4.5 to 5.5, but it's a long way down. And I think people ask me, when is that going to actually play out? How do we know? How can we believe this? It will simply be through month-on-month production adds where they just can't keep up with whatever they're targeting, be it 400 or potentially 250.
Christian, the idea of $150 a barrel oil comes from the idea that demand is going to pick up back to pre-pandemic levels by March of next year. How does the Omicron variant really play into this at a time when we see people canceling their travel plans and we see a lot more uncertainty in the global vacationing space, if nothing else?
Yeah, you're absolutely right. And I was hoping you wouldn't ask that question, but the whole thing is anchored on demand. It's almost like it's 99.9% of our thesis that demand actually continues to recover and grow. And we've already adjusted in the context of a weak aviation outlook in Q1. Clearly, that was, Omicron is going to be somewhat uncertain, but we do think as a house to add on risk because we do see demand recovery. Mark Kolomovic also talked about that in his recent piece, to buy the dips. And the reality is that, we're sort of coining this variant potentially the omega in the sense that this is potentially what qualifies for a risk on trade because immunity will continue to be strong, and we don't think that hospitalizations will actually end up catching up with the cases. In other words, even if I have high cases, it won't actually fundamentally impact the demand outlook. Now, if we do see demand potentially damaged, we're at around 100 million barrels for next year, I do expect then OPEC to take action.
Christian, the perception in America is the Democrats, President Biden, Secretary Granholm, are against American oil. And in our conversation with Secretary Granholm, what she emphasized is oil is one global price. Is it?
It is one global price, and it's set ultimately by the marginal producer. And if the marginal producer can't deliver owing to productivity or federal land restrictions or Wall Street, that marginal role moves to whoever does have the spare capacity. And at that point, the question is, what oil price do they want? And I think ultimately, when we think about EN countries, I understand the point around wanting to keep prices low, but that global price, Rob, ultimately drives significant revenue for a lot of the poorer EM countries. And so there's a sort of interesting tension between the consumers and the producers. And I think that then segues into OPEC's ability to actually manage this balance between having to keep the West and sort of restrict inflation versus the EM countries that rely wholeheartedly on this as a revenue source. But the bottom line is the marginal cost of the marginal price setter is shifting to OPEC. Then it all comes down to how much additional barrels they have. And this is the point where it's almost like you can ask them to do whatever you want, but the question is, can they actually do it?
Well, Christian, just real quick here, does this give them incredible cover, the Omicron variant, to basically not boost production for January at their meeting that ends today?
It does. It gives them cover, and it actually gives them a breather, which is that you can actually go back to your reservoirs, focus on the technicals, build your inventories, and delay. And at that point, when demand recovers, and we don't see it being damaged, but ultimately as it continues to grow, you then have these barrels for a higher oil price and a sunnier day.
Christian, before you run, because we've got 60 seconds left, I want to make sure we use all the time we've got with you. Just briefly, do you think this asset class has taken a bit of a hit? The credibility of it has taken a bit of a hit recently?
It's a great question. And I think this route that we've seen, we're in a bear market for oil, ultimately creates this volatility kind of paralysis, which is, you know what, I don't want to go on holiday and come back and oil's down 30%. This is just too high octane for me. And so with that in mind, I think that being able to put a floor on price is important. Ultimately, that's OPEC's role in some ways. But equally, the geopolitics of oil can often sort of get in the way. And this is where I think if you just take a step back and just cut through it all, we've got to come back to what's the marginal cost to produce this stuff. And that's what we're trying to say here. I mean, $150 oil call is clearly quite, bold, but people are missing the detail, which is actually what we're saying is the $80 long-term oil price is what you're going to need in order to produce the additional barrel. And that's bullish for equities.
Christian, just absolutely fantastic. To hear the work that goes behind a call like that is just brilliant. Christian Malik there of JP Morgan, Tom out of London. Brilliant.
Yeah, just absolutely brilliant. On oil, Jeff Curry later today as well, John.
Looking forward to that. From New York City, on radio, on TV, for our audience worldwide. This is Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Up front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
The market's going to have to be significantly repriced at some point. The Fed will probably have to go, faster than what people expect. They'll probably have to go higher than what people will expect. And that's going to be a bit of a shock to financial markets.
Bill Dudley there, Bloomberg opinion columnist and Bloomberg economics senior advisor, former New York Fed president, making the point that maybe they have to go faster. Tom, when I first heard Bill Dudley say that in the middle of this year, it was at a conference with him and Mohammed Al-Arian about 6-7 months ago.
Yeah.
And it was out there. Let me tell you, it was contrarian. Not anymore as we close out the year.
Yeah, they look like geniuses on the trend here back 6-7 months. The mystery, again, has been our theme through the day. Who knows on all that? One thing we do know is the linchpin of all this will be the deepest thing in the market, which is the U.S. dollar. We welcome Kriti Gupta to join us here. This is exciting for us to have Kriti join us. Is Dave, who was it? Dave who?
Dave Wilson, I think, was his name.
Come
on. Sounds familiar.
Kriti Gupta joins us right now on the dollar. What do you see in the dollar right now? We see a lot of ambivalence.
Yeah, well, it's been a lot of hedging at the moment. We've seen this huge buildup in the dollar. You've seen a lot of dollar strength. It's kind of echoed throughout the equity classes. But then in the last couple of days, with that equity volatility, you start to see hedges, FX portfolios essentially having to really deal with the equity volatility by shoring up their portfolios or selling, for that matter, with the dollar. And the ripple effects there are going to be in the euro, in the EM, which is kind of counterintuitive to what you're seeing with the COVID variant, to the broader narrative. And on that chart there, it just shows you that that buildup, that hedging, has been there for a while, but in the last 2 months, it's really accelerated.
Kriti, we're on radio as well, so it's not that chart there. Lisa, it's a chart showing the lines going up.
Yeah, the idea to me, honestly, is what Rich Kosterich said earlier in the show of BlackRock when he came out and said that he's increasingly going into the dollar and bullish on the dollar because it is a great hedge for stock volatility. It's actually been the most reliable hedge. How much of the action that we're seeing in the dollar and wagers around it really stem from macro bets looking for some sort of reliable hedge?
Yeah, well, I think you nailed it there. What's ironic here is that in the last year or so, even in 2020, the inverse correlation, and I think Russ mentioned this earlier on your show, you had the dollar essentially feeding into equities. The dollar lower, stocks higher, essentially foreign investors could make it easier to hop into the stock market. And Elisa, right now you're seeing the exact opposite, essentially equity moves dictating who hops into the dollar.
John, do you see she's been here for a cup of coffee and she's already siding with Lisa. Do you see how she said Lisa nailed it?
It's a smart thing to do, Tom. To take you on early on.
You guys are trolling me.
That's what you should do.
It's just like, that's a one-day shot.
That's a strategic move there from Kriti, Tom.
Kriti Gupta, thank you so much
Come back, Kriti.
for that informative chart in nailing it with Abramowitz. Damian Sassower always nails what's going on in the emerging markets and gives us a brief this morning. Damian, an open-ended question to you. What matters on this Thursday?
Well, I think all eyes are certainly on the Turkish lira, especially after Erdogan replaced the Minister of Finance, Lutfi Elvan. Lutfi's been on the job for less than a year. He had served under 3 prime ministers, including Erdogan. He was replaced by a deputy finance minister by the name of Nuruddin Nebati, and Nebati is close with Erdogan's son-in-law. Erdogan's son-in-law was formerly the economic czar of Turkey. He was responsible for going through the FX reserves and basically spending about 128 billion of them to protect the lira a few years back. And so, look, this is more of the same, reduced policy credibility. And for me, it's looking forward to 2023, where the smart money, I think, is now betting on perhaps a regime change at the top. And so, yeah, I guess, that's what, we're focused on here today, Tom.
Well, Damian, we've been also talking extensively about whether this is idiosyncratic drink or whether this is something that could potentially become a little more systematic in terms of its connection to the broader market. How isolated is Turkey as it sees its currency weakened, some of the weakest levels we've ever seen?
Well, we released an awesome research deck today, Lisa, that explains that, look, this is really isolated. If you look at the reserve positioning across the whole of the major emerging markets, there are 19 of them, including Turkey. 18 of them 18 of them have seen their reserves go up over the better part of the last 18 months since the pandemic. And so, they're in a better position. They have a better reserve positioning relative to imports, relative to money supply, yet Turkey is in a very different situation. So look, if you want to see contagion spill over, it's going to be, weaker lira. How does that affect the banks? And how does that spill over into the broader global financial market, which, appears to be limited at current, given capital account balances, bank balances, and the like.
Damien, just to build on the price action, do you take any confidence whatsoever that the bounce today, the move is only about 1 or 2 percentage points off the back of what happened overnight? Does that tell you anything about maybe the exhaustion of selling the Turkish lira?
No, not really. I mean, the reality is the only people who are in there, Jonathan, kind of in that market are real hedgers. There's really no speculation. I mean, it's just too expensive to speculate in that market. I mean, look, we have CPI coming in tomorrow. It's going to be at 20%. I mean, the 1 week repo rate, the policy rate's now at 15%. Negative real yields. The current account surplus is going to plunge back into deficit. GDP growth is coming down. It's come down from 21 to 7% in just the last 2 quarters. I mean, the economy is in trouble, and certainly we're seeing a bit of unrest on the streets. We're seeing a bit of rioting, a bit of protests here. The AKP in the polling, that's, Erdogan's ruling party, is at an all-time low. I mean, consumer confidence, all-time low. Again, it's not good for Turkey, but not so bad for the rest of the emerging market complex.
So the unfair question, Damien, does it move from idiosyncratic to contagion? We've asked that many times this week, because we seem to be going day by day. How contagion-y is Turkey getting?
I think if you want to look for contagion, it's going to be look at the European banks, look at BBVA, look at some of the banks that have basically been in there supporting guarantee. That's really the extent of the contagion in my eyes. I mean, look, we can get into S-400 missile systems, Tom, and the political risk therein. We can get into the Syrian migrant crisis. We can get into the canal that Erdogan is supporting, that his son-in-law has real estate along, the adjacent to the Bosphorus, so to speak, the Montreux Treaty. But why bother, right? Who cares? At the end of the day, we see 1 month 25 Delta risk reversals at an all-time high in Turkey, and no one cares.
John, this is great. I mean, for those of you on radio, I mean, John, let's be honest. I mean, it's work from Hunting Lodge for Damien Sassauer. It's like 70 acres. He shops up there.
The fire's on. That looks cozy.
This is north of New York, John. He shops everything at the Accord Market. Everything in the damn lodge is gluten-free.
Damien, it's good to catch up. It's good to see you. Damien Sassauer there of Bloomberg Intelligence. I'm distracted because the UK Works and Pensions Secretary said on British TV this morning, Tom, for what it's worth, I don't think there should be much kissing under the mistletoe. You don't need to be doing things like that. Lisa started spoiling the holiday season
get together
earlier in the show, and now in the UK, Tom, they're saying no kissing under the mistletoe.
Are they locking down, John? This came up last night at the dining room table. I mean, there's sort of a mystery to what Heathrow in the United Kingdom's doing, right?
There is so far. There is a new testing regime, Tom. They're tightening that up a little bit. You've got to go back to day 2. Within 2 days of arrival, you've got to have a PCR test. I think you've got to arrive with a PCR test as well. What's going to be interesting for me is if they do anything longer than that, anything up to 5-8 days. Again, if we start playing that game again, Lisa, that's going to be a huge problem for the hospitality industry, for the major cities in the UK, like London, for instance.
And frankly, that's why you saw the huge move in the parent company of British Airways immediately on the back of this. Just to set the record straight, have you ever done that with mistletoe? I'm sorry, just to educate me. Yeah, is that actually a thing? Do people actually do that?
Do people do that, Tom? Have you ever got the mistletoe?
Is that a thing?
Kiss Mrs. Keane? You've not?
He's pretending to be deaf.
You're pretending you can't hear us?
He's pretending he can't hear. He's just saying, get me off of the set. It's too awkward.
Is that something like...
My agent Ken Cooper says... My agent Ken Cooper says, put a cork in it.
Up 15 on the S&P from New York City. We fade a little bit. This is Bloomberg.
目前眼前状对我们军方来讲的话，我只跟委员报告，是我从军以来40多年以来看到真的是最严峻的时候。要翻台的话，他目前有这能力，都有的啊，但是要看怎么一个结局。说我们不做任何挑衅啊，但是说把他激怒了，就跟我们人一样，你把我激怒了，我手上能力我也会发挥出来。所以2025是我们研判要全面啊，我们这样研判的。
China has, I've spoken with Xi about Taiwan. We agree, we'll abide by the Taiwan agreement. That's where we are. And we made it clear that I don't think he should be doing anything other than abiding by the agreement.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this
story. How are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
You can either lose money slowly or you can lose money quickly.
There's a lot of what's going on in the market now that is pure risk management.
The level of accommodation at the moment is so high.
All signs point to something that looks better this cycle.
For now, corporate profitability looks pretty good. I want to be a part of that.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. An incredibly busy hour. We will look at Apple. We will look with Michael Dart at the American economy. Yes, we'll look at the stock market. You know what, John? None of it matters. Claims at 8:30 gets us ready for the jobs report tomorrow.
Payroll's coming up tomorrow. Looking forward to that, Tom. And then we look ahead to next year as well. And a Federal Reserve meeting in between on December 15th. I'm reminded of that quote, Tom. There are two kinds of forecasters, those who don't know and those who don't know. They don't know. Which one are you as we look ahead to next year?
I'm not going to forecast, but what I am going to say, John, is we have a changed landscape on travel. Helene Becker will join us on international travel here later in the hour. And John, I look at what's going on in Germany, the article by Bridget Jen and Patrick Donahue and Arne Dels. I mean, they make clear Scholz is making a mark.
More testing, more restrictions said to come out of Germany. We'll bring you those headlines when they break. Tom, this equity market breaks down a little bit again. NASDAQ 100 futures down a tenth. S&P 500 futures well off session highs, positive just 14. We're up 1/3 of 1%, Tom, and we fade.
Yeah, we fade. Lisa, you see in the equity market, a VIX back out near 30, 29.55. Lisa, what do you see in bonds, in credit?
And the idea here that you have a Federal Reserve that will be tightening next year, that according to the consensus baked into markets right now, and you are not seeing a material tightening in financial conditions. Yes, you're seeing riskier yields go up, but it's nothing that dramatic. Funding costs are still very low. To me, this gives the Federal Reserve a green light, Tom, to continue with its plan, because right now people do not seem to be concerned about tightening. They do not seem to be concerned about another taper tantrum. Whether that'll hold, of course, remains to be seen, but I do find that compelling.
John, what kind of a day are we going to have? I mean,
I wish I knew that, Tom.
you see some good news here with the Dow futures up 200 points, et cetera, et cetera. You and I take the surveillance nap apart. And John, I mean, I just got to say, you wake up from the surveillance nap, what's there?
I like how you had to stress that we were apart when that happens, Tom. Thank you for clarifying that. I'm with you. When you woke up after that nap yesterday and we found out there was a case in America, let's get real about this. That was absolutely ridiculous. Of course there's a case in America. What we still don't know are the answers to 3 questions, and I'll keep repeating them until we get some answers. How severe is this variant? How effective are the vaccines against it? And how contagious is it? Have you got any idea right now?
No, I don't. If you're just joining, Lisa does, because if you're just joining us right now, the theme here is Farrow and Keene have no idea what's going on.
That is true.
And Lisa is totally clued in. There's no question about that. John, let's do a clueless data check. I'm going to look at the VIX. 29.51 is a little bit of angst.
I'm going to look at crude, 65.78, positive just 1/3 of 1% on WTI. And I'll promote an interview that took place on this network with our audience 30 minutes ago with JP Morgan looking for 150 on Brent, Tom, in 2 years' time. We're going to try and get that out for you on the Bloomberg terminal and on Bloomberg.com as soon as we can.
Their base case critically, not from 60, they move it up to 80. Adapting to all this is Brent Schutte, Chief Investment Strategist at Northwestern Mutual. We're thrilled to talk equities with him. Brent, there's been a run on energy and then a pullback. How do you manage sector weights at Northwestern Mutual when we see such segmented performance, including in oil?
Well, I think you ignore the day-to-day movements that you've been talking about and trying to kind of discern what's going to happen as you move towards the end of the day. Look, I think as you look into next year, you still have incredibly accommodative financial conditions. Yes, you have a Fed who's tapering just a bit and may accelerate that and might actually even increase interest rates. But let me ask you a question. What impact do you think that's going to have on economic growth? I think given where the consumer is, I think given where companies are, I think it's going to have little impact. Now, it could certainly have an impact on the market. That's a fair question. And I think it actually pushes people towards those names that you mentioned because the other names in the market are quite frankly expensive and overbought. Yes, they are secular growers, but how much of that has been pulled forward by things like the Delta variant, by COVID, by things arriving at your door every day? I think there are still opportunities in things like energy, value stocks, where they are incredibly cheap. And I hope someday again in my career, we focus on valuations over hopes, dreams, themes, and memes.
Brent, you're asking a really important question. In fact, you asked 2. At what point would higher rates bite the economy? At what point would higher rates hit the market? Given how deeply negative real rates are right now, Brent, what are the answers to those 2 questions?
I think you hit the nail on the head. I mean, to me, financial conditions are going to tighten a bit, but are they going to tighten so much to cause a recession? Are they going to tighten so much that they're actually going to extremely harm economic growth? I just think when you look at the underlying fundamentals, look, I don't care how they got the money. The consumer debt to net worth is 12%. It was 24% in 2008. The cost of that debt is still incredibly low, and most of the consumer debt is fixed because it's in mortgages that have been fixed for the past 13, 14 years. And so to me, there will be an impact. It's at the margin. Certainly, we are inching along the economic cycle, but we're nowhere near the end yet.
So it doesn't change your scenario at all that the Federal Reserve is seeing inflation as the bigger threat right now, potentially, than a labor market that does not get back up to speed, because that seems to be the pivot that we heard from Fed Chair Jay Powell.
I must have heard something different than many people heard, because I heard Chair Powell still say that he doesn't believe that inflation is going to leave a permanent mark. Look, I think the Fed doesn't want to appear to be tone deaf. I think they want to actually give themselves some optionality. I think they believe, like me, that the tapering is necessary. It doesn't need to be. Do we need that anymore? I don't think so. But I still think the Fed wants to try to cement the long-term growth rate of the U.S. economy and increase that by bringing people back into the labor market. If they don't, our longer-term growth rate is much less. And so I do believe they're going to try to stick around as long as they possibly can, like they did the last economic cycle, to see if they can get the participation rate up, because longer term, that helps determine what our growth rate can be. And if we're at levels we currently are at right now, we could be in some trouble.
How far do you go in terms of going into risk, going into the reopening trade, going into the recovery in cyclicals? Do you go into airlines right now and they get beaten up? Do you go into banks kind of trying to pile into that trade, banking on the idea that yield curve dynamics will change in your favor?
But we never go all in. We do run balanced accounts where we actually have exposure to different factors. My fear is that as I travel around, as I look around at what people are doing, they are still heavily on the growth side. Now, the good news is some of the starch has been taken out of that. You've seen some of those hopes, dreams, themes, and means, ETFs and stocks pull back a bit. but I think there's still room on that side. And I want to make sure that people still have money tilted towards things like value, tilted toward things like small caps, and where small caps are, quite frankly, historically as cheap as they've been, and they're actually expected to grow earnings more next year.
So, Brent, this is not a hug the index year for next year. Just to be really clear about this, I can't just hold on to the S&P and sleep well at night through next year.
No, I think you need to own other things besides the S&P. I've said it before, I'll say it again. Parts of this market remind me of 1999. That scares people. That shouldn't scare you. All that means is you need to be outside of things that have done incredibly well and been bid up for the past 5-6 years on earnings growth that may not actually happen. At some point, valuation will matter again, and I'm hopeful that is in 2022.
Tom, that always scares people for good reason. When anyone brings up 1999, there's a reason, TK, they're scared.
Well, they're scared. Yeah, they bring up 99, and it's the top of the market. But what I heard interview after interview of Bulls and Bears, John, is simple. You can't do an analog to March of 2001. The profitability of technology now is partitioned into those that maybe have some profit challenges, but a lot of technology that's minting money. That's different.
Brent, can you speak to that? The names that are the heavyweights in this S&P 500, they're making a lot of money.
Absolutely. That is a nuanced difference between now and 1999. I guess the question to me is how much of that do you think was pulled forward by COVID? How much of that has already been paid for and already been priced in? I mean, the gap between growth and value is as wide as it's been. Many people have abandoned value altogether. I hear it quite often on sometimes on your network where people say value doesn't work anymore and it's more thematic investing. I think thematic investing eventually is going to require those companies, not the ones that you just mentioned, but those other companies, to actually bring the earnings forward and actually produce them. At some point, that bill comes due. And if rates rise in 2022, if the economy continues to grow and interest rates actually elevate just a bit, I think that bill comes due next year.
Brent Schutte, great to catch up, sir, as always. Northwestern Mutuals, Brent Schutte there on this equity market. Looking ahead to next year, we've talked a lot about the time for active management, Lisa, and maybe it's time to move away from the index. Let's be clear, this year the index has delivered big time. Brent pushing back against that for next year.
And this really does assume that we aren't going to be entering a really tumultuous period next year as the Federal Reserve tries to wean the market of some of the stimulus, of some of the accommodation. You know, people talk about the lack of a tightening in conditions. Is there going to be a tipping point, John, at which point people realize that liquidity is being withdrawn from the markets and things get more volatile? And this is actually a key distinction in a lot of prognostications for next year, talking about a difficult second half of 2022.
Well, is this it? Is this a flavor of what we've got down the road?
You know, if this is a flavor, it's not that spicy, right? It's not that concerning, considering the fact that we're still pretty close to all-time highs. However, how far does it go, and what does that do? What does that volatility do with respect to funding, with respect to just in general risk valuations?
It's the question of the moment, isn't it, Tom? And it's the question we'll keep answering. Trying to answer anyway. How much work does this Fed need to do to tighten financial conditions, given how deeply negative rates are right now? We have an idea, though, Tom, of how loose things are right now and how deeply negative rates are. We have an idea of that.
I would suggest if we had John Taylor of Stanford University on, he would say, clearly he would say we're too accommodative. I'm sure we'd hear that from Professor Taylor. But I think in the new math of this fiscal reality we're in, John, nobody has a clue where we switch from accommodative to restrictive. No one has
even
any
me, by the
idea
way,
whatsoever.
Just want to say that. He keeps saying that I know everything, and you know.
You agree on something.
We agree.
You agree that you don't know nothing.
Can I point out, and you know, Brent Schutte just crushed me.
Sure.
There. I mean, I just shut up, and I'm starting my taxes this morning, and you know, I just want to point out that for nails at the score today is Lisa 2, John 1,
When did
and
I
as
get 1
usual,
for?
I'm down in flames. I mean,
I think it was -5 after what you did a little bit earlier in the show to me, using my own language against me. Anyway, Tom Fordy's coming up later, senior research analyst at D.A. Davidson.
Just like going down in flames.
Looking forward to that. Like this segment right now, Tom.
Yeah, I think Tom Fordy's going to say to you, John, just to make you feel good, gee, John, you nailed that.
I hope he does.
Yeah.
Let's see if he does. Up 22 on the S&P, up 0.5%. Heard on radio, seen on TV. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Apple has a problem it wasn't expecting with the iPhone 13. Bloomberg's learned the company has told suppliers that demand for its newest device has weakened. It's a signal that some consumers have decided against trying to get the hard to find them. Apple has already cut its iPhone 13 production goal because of a lack of parts. 5 months ago, President Biden declared the U.S. was on the verge of defeating the coronavirus. Now the virus is threatening a resurgence across the country. The Omicron variant has been detected. Today, the president will lay out his latest plan to quell the pandemic that has dogged his time in office. It will include stricter testing for travelers from abroad and extending a mask mandate. U.S. Secretary of State Antony Blinken warned of serious consequences if Russia makes a military move on Ukraine. Blinken met with his Russian counterpart, Sergei Lavrov, today in Stockholm. The Kremlin says it sees a growing risk that Ukraine may attack Russian-backed separatists there. And in Brazil, the economy has slipped into a shallow recession. Aggressive interest rate increases and surging inflation are hurting consumers' purchasing power. That's dealt a blow to President Jair Bolsonaro just as he prepares to run for re-election. Brazil's GDP shrank 0.1% in the third quarter after a 0.4% decline in the second quarter. China is on the verge of lifting an almost 3-year grounding of the Boeing 737 MAX. Chinese regulators have lifted the last safety-related obstacle to bringing the MAX back, issuing an airworthiness directive. China was the first country to ground the plane in 2019 after 2 fatal crashes. It's the world's second largest aviation market. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Do you think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has 3 very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one-directional traffic from the U.S. to the U.K., and now it's open, of course, to U.K. nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
Every Friday with 30 minutes dedicated to fixed income. I'm Jonathan Ferro. This is Bloomberg Real Yield.
Right now, with the inflation data the way it is and with the job market as strong as it is in many dimensions, I do think that, we have to be in a position that if we need to raise rates, a couple of times next year, we're able to do that. So again, quickening the tapering gives us that optionality.
The Federal Reserve building in some flexibility. That was Loretta Mester there, the Cleveland Federal Reserve president, catching up with Kathleen Hayes on Bloomberg yesterday. From New York City this morning, good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro. Your equity market up 20, fading a bit, then bouncing back up 0.4%. NASDAQ 100 futures slightly negative, softer down by about 6 points. Call it 5. We're negative 0.03% there. Yields are higher by not much now, by 2 basis points to 142 on 10s. And your stock mover of the morning, it's Apple in the pre-market. Reporting from our team here at Bloomberg, the company telling its component suppliers the demand for the iPhone 13 lineup has weakened, according to people familiar with the matter. 160.40 in the pre-market, down by 2.65%. A snapshot of the analyst ratings, TK, just quickly. 38 buys, 8 holds, 2 sells. Your big bull on the street right now is Dan Ives of Wedbush at 200. And Mr. Forte over at D.A. Davidson looking for 170, Tom. We are at 160 right now.
We look at the opportunity here right now as we will. Also, I want to point out we're looking for a miracle press conference out of Germany, which could be of interest. Tom Forte joins us, D.A. Davidson as well. Tom, let me cut to the chase. Do you buy the dip?
You do buy the dip, although, Tom, I do worry a little that some of the $160 price of Apple is on a growing assumption that they're going to enter electronic vehicles. But if you look at the multi-year upgrade cycle for 5G, I think that's still intact. Potential softness in demand to me is consumers responding to all the news that they're not going to be able to get the product they want. If you get at Apple's website, you can see there's still a delay for the Pro and the Pro Max, the highest end of the 13 devices.
What, in your analysis, and I'm talking about the famed 4-day spreadsheet, how do you price in the price war of Verizon, Telephone, and T-Mobile? To me, it's like 15 years ago. It's absolutely stunning the price deals are giving people. Is that in the stock?
It is in the stock because I do think, as you pointed out, it is back to the future to the extent that the carriers having invested billions of dollars to upgrade their networks want you to have a 5G phone. And if you see the Verizon ads, for example, bring in your broken phone and we'll give you full credit, it is remarkable because it wasn't that long ago where the carriers stopped giving the stipends and put more on the consumer. And that's when you started seeing consumers buying their Apple on, monthly payments and installments and things of that nature. So it is a gift by the carriers to Apple.
Excuse me, apologize. Tom, there is a question about whether this is an idiosyncratic issue having to do with people waiting for the 14 model of the iPhone for Apple, or whether this is actually a sign of how some of these supply chain disruptions actually dampens demand, that people don't want to go to the stores if they don't know how long they have to wait. Which is it?
Great question, and I think it's the latter of the two. I think the consumer, unfortunately, is being trained that if you want a consumer electronics product this year, you're probably not going to be able to get it, so they're not trying. Some of them are not trying.
Is there a larger takeaway then, Tom, about other electronic companies, other companies that rely on the chip sector, which has been particularly weighed upon by some of these supply chain disruptions?
Yeah, it's a great question. The way I think about it is, on the most optimistic front for supply chain disruption, I think you can look at large-scale retailers like Best Buy, and they may realize they can't get products shipped from Asia on the shelf in time for holiday and quit trying. But if you're a company relying on chips, that could be an issue for full year calendar next year. We cover a headset manufacturer. They've had to re-engineer their product 3 times to adjust for chips that are available. So the chip situation could be a full year 22 issue, but we may see some improvement in the supply chain sooner rather than later, independent of chips.
Tom Forte, under your risk, and folks, in every sell-side research report, there's a listing of risks. Is President Xi in Beijing a risk for Cupertino?
I would say under Tim Cook's leadership, it is less of a risk to the extent that he has done an amazing job managing China risk. I think what you're seeing mostly, unfortunately, has been incremental pressure on Alibaba, Tencent, some of the domestic technology companies there on data concerns. Tim Cook has done an amazing job managing the risk in China. So I think it's a risk, but it's less of a risk because of the excellent work Tim Cook has done.
Next year, Tom, what do you think is the biggest distinguishing feature for the likes of Apple, for the big tech complex, as we head into what a lot of people think will be a shift, a rotation into the rest of the sectors that really have gotten beaten up or not really recovered to the same extent?
Well, I do think that there's a perception that Apple and some of the large tech stocks, Amazon, Google, and others, are somehow a safe haven. So maybe that view goes away next year. But I didn't think we saw as much sector rotation out of technology as I expected in 2021 on an improving and reopening economy. So I think there's still, this 5G upgrade cycle, I think, could carry Apple stock independent of sector rotation in 22.
Well, do you want to announce a price increase right now? We need to make some news here, Mr. Forte.
I'd love to, but I'm sorry, not at this point in time. I think that, again, Tom, my concern is that some of the 160 is an expectation that there's a mini Tesla or Rivian or something like that in Apple, and that there's a call option embedded in the price. So I'm going to continue to monitor the demand. If you think about the quarter, they had a $6 billion hit to revenue in the September quarter related to supply chain. In the December quarter, that's like 6 lost days of revenue. So look for additional details in the December quarter at this point in time before considering increasing my price target.
Tom, great stuff, as always. Tom Forte there of D.A. Davidson on Apple. Apple down in the pre-market by 3%. Brian Deese, the director of the National Economic Council for the White House, Tom. The White House putting out some really important data over the last few weeks. They put out a supply chain dashboard just to give you a feel on how things are improving. So imports arriving at ports of LA and Long Beach are up 16%. Year to date. Gives you an idea of how much volume we're seeing go through these ports. Here's the improvement, though, since November 1st. So-called long-dwelling containers. These are containers sitting on the dock for 9 days or more, down 41% since the 1st of November, Tom. That's good news. We're making some progress here, and we picked that up a little bit in the ISM yesterday, too.
I see that, and John, I must admit, not the gloom crew, but the people looking for a slowdown in real GDP, call it under 4% or so, they've fallen quiet.
The outlook for next year is decent on the GDP side. Lisa, this comes down to supply constraints, both of goods and labor, and that seems to be the big variable for the likes of Morgan Stanley, the risk that we get an earlier move from the Federal Reserve.
Yeah, and honestly, this is the reason why you are seeing some optimism. On the flip side, you do have services coming back on. Do we see the service section inflation start to take over before the goods inflation falls back?
Futures up 12 on the S&P, advancing by about 1/3 from New York City for our audience worldwide. On TV and on radio. Don't forget, we're live on SiriusXM channel 119 as you head into work.
There's a pretty good chance that you use products made by Meta every single day. If you've never heard of Meta, that's because it's the new name for Facebook Inc., the parent company of Facebook, Instagram, and WhatsApp.
All right, perfect.
In a spiffy presentation on Thursday, Mark Zuckerberg showed off his vision for what he's dubbing the metaverse. That's a sort of mix of augmented and virtual reality worlds which will let the user explore virtual ecosystems. Much of what he showed isn't yet available. It's really his vision. In that sense, it was more like the sort of presentation Elon Musk does, where he looks at what he hopes might happen one day, than what Steve Jobs does, or Steve Jobs did, which is showing off products he already has available. He also, in the course of it, announced a name to Meta. The company will be called Meta from now on.
Our mission remains the same. It's still about bringing people together.
That's an effort partly to show the vision for the future, but also a way of casting adrift some of the toxicity associated with Facebook. But if this new company is going to be a success, or the new company vision is going to be a success, he will still have to deal with a lot of the same challenges that Facebook has faced. Concerns about privacy, content management, those are going to be just as pertinent, if not more so, in the metaverse as they are right now on Facebook's existing apps.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Jobless claims in America seconds away. From New York City this morning, good morning. Tom Keene, Elisa Bramis and Jonathan Ferro. Your equity market up 1/3 on the S&P. On the NASDAQ 100 down 32, negative 0.2%. And this curve is flatter. Let me tell you that. Yields are higher at the front end by almost 5 basis points. The 10-year up by only 2. Yeah. Your curve threatening to break below 80 basis points. With your claims data, here's Mike McKee.
Well, John, the big surprise of last week lasted just a week. Claims do rise to 222,000. Remember, everybody's jaw dropped when we got the report. It was 199,000 last week, which was the lowest since 1969. The revision is the numbers have been revised up for last week to revised down rather to let me see here. 200. Well, I don't have the exact.
You okay over there?
Yeah, I'm just trying to figure out. They've got a lot of numbers in it this time because they're doing historical comparisons, and it's.
There's nothing worse, Mike, than when you're trying to get your words out and Tom just reaches across the desk and goes,
right on top of
you.
You.
Okay over there?
McKee is world famous at this, folks, and McKee doesn't understand on surveillance. You can make up the number, Mike.
Tom's never lost
so
his
there were
words.
2 jobless claims last month. That was John and Lisa standing in line, and that was it. This will be in a kind of funny way reassuring because it's more realistic than the 199, which everybody thought was an outlier, but it's still very low. Okay, here's the number, 194. So we thought it was 199, and now it was 194. Don't know what happened. Nobody really does, but that was what was reported for that week. This now is a little more realistic at 222. We're back in the range that we were in, sort of the movement that we were in on an ongoing basis before last week.
And John Farrell, the 2-year yield gives you some love. It's a little bit higher.
I look at this. When Tom says, I look at this, and he takes a beat, it's because he's not been listening to anything. Just so you know.
Got that right.
Going forward from here.
I'm starting my taxes, John. It's December 2nd.
I look at this and I look back to 1922, and futures are up 17, Tom. I'm with you. Yields higher by 5 basis points at the front end, back through 60. TK, the curve's flatter going into payrolls tomorrow. Claims, this is the claims data we've been waiting for now 18 months, down back towards the 200K we were living at, Tom, before the crisis, before the pandemic.
It is. Michael McKee, one more observation here, if you have the correct numbers this morning.
I have the correct numbers this morning. We can tell you that the 4-week moving average is 252,000. That's a drop of about 21,000. So
there you go.
We are seeing claims back off, and make of that what you will going into payrolls tomorrow.
Mike, great work as always. Looking forward to catching up later and tomorrow, of course. Payrolls tomorrow, Tom. The median estimate right now, 546,000.
Our theme this week has been uncertainty. It's out there, and one of the best people we know to measure uncertainty is a gentleman out of the Wisconsin complex of economics. Birthday boy Michael Darda joins us this morning. Michael Darda, happy 39. Thrilled to see you cut and chiseled at 39. Michael, you mix in the stock market synthesis with some wonderful economics. I want to start with the animal spirit that links the markets to our economy. What does our nominal GDP look like forward?
Well, it looks pretty incredible going into the fourth quarter, Tom. We have tracking estimates pushing 10% for real GDP quarterly annualized in Q4. The PMI data yesterday would have been consistent with at least a 5% real GDP handle for Q4. But I think it'll be stronger than that. And with high inflation, we've got nominal GDP running well into the double digits. So this is a very hot economy, but risk markets are jittery because of concern about this new variant. And then obviously, Fed Chairman Powell has pivoted this week, I think completely appropriately. So we've got a bit of a dust up in volatility, but these things happen, and this is an economy with tremendous forward momentum, and that is a good thing, not a bad thing.
What is the choice set that the Fed will have, not at the December 15th meeting, but if I wander out and folks, a great terminal function on this is FOMC. If I stagger to January 27th or the March 17th meeting of next year, a St. Patrick's Day meeting, what will be the choices the Fed has at that time?
Well, I think the Fed really does want to wind the taper up before mid-year next year, so they have the flexibility to start raising short-term interest rates if the economy continues to perform as it has been. Let's take a step back for a moment and recognize that the Fed is still doing quantitative easing, albeit at a slower pace each month, with an unemployment rate in the mid-4s and plunging, okay? During the last cycle, the unemployment rate fell only very slowly. This is a much more rapid recovery, and we're very far along towards full employment, with the Fed still doing QE and pinning short-term interest rates at zero. That is a policy that will cement a more permanent inflationary backdrop in place if policy doesn't adjust. And so if we're talking about, retiring temporary and transitory, a big part of that is adjusting the policy stance to a more neutral level. And that's going to require the Fed to wrap up quantitative easing sooner. And that's the right thing to do, in my opinion.
So take it a step further, Mike. In order to fight what you see as what otherwise will become a very persistent high inflation rate, what do next year?
Well, I think if they get going sooner with an economy that has a lot of momentum, that should actually increase the probability that we don't have a hard landing later on. What you don't want is a situation where the Fed falls so far behind the curve, inflation and inflation expectations become embedded, and then there's a panicky catch-up to adjust policy later on. And that's the go-stop cycle, and the stop part usually means a severe recession. So better to start doing adjustments that don't have to be panicky and radical earlier when the economy is strong, and hopefully we'll be able to preserve the business cycle going forward. And so that's really the key here. But I just think it's important for people to understand this is not the last business cycle. We've got double-digit average annualized nominal GDP growth since the economy bottomed last year. In the last cycle, nominal growth was running 4% per annum on average, with sub 2% inflation. Those variables look nothing like that this time, much, much, much stronger. And so if we go back to the old Milton Friedman concept, which is that money times velocity equals prices times output, prices times output, nominal GDP. So by definition, the Fed has a much more accommodative monetary stance this time. And they're going to need to adjust that by policy closer to neutral.
I'm going to channel Danny Blanchflower of Dartmouth, who would come out and say people are ignoring some of the warning signs on the peripheries. The idea here that you have consumer confidence that fell dramatically in the face of some of the inflation reads that we've been seeing and what they see in the grocery stores, and that the participation rate really has not gotten back up. In fact, it's still far below where we were pre-pandemic. How do you respond to these issues? Is this the new normal that we're facing and that the Fed has to sort of reckon with? Or if we keep policy easy, do we start to see more people come back into the labor market?
Well, on participation, I don't think anybody really knows exactly what's going on there. The hope was with schools reopening and the pandemic receding until this recent news that we'd start to see a pickup in labor supply. And that may still be in the offing, but so far the numbers have been disappointing. In the meantime, the labor market is tightening drastically. I mean, we've gone from, almost 15% unemployment in the eye of the storm last April to the mid-4s. And the Fed is still doing QE and holding short-term interest rates at zero. So, I think the question is, how far along do you want to cook this thing? And yes, inflation's already high. The temporary transitory folks, let's just face it, they've been completely wrong. Even if headline inflation falls next year, that crew was just simply incorrect in terms of magnitude and timing. So you have a lot of forward momentum in this economy. Yeah, confidence is definitely looking a bit soft, but you have a strong labor market with jobless claims. We just got the 222 figure. That's an extremely good figure. So this is not new in terms of this debate. We've had previous waves of the virus, even before the vaccines, didn't stop the recovery, didn't stop growth, didn't stop unexpectedly high inflation. So, at some point, those making those arguments over and over again incorrectly, I think, are going to have to, think about adjusting their view.
Mike, we've seen a lot of adjustments in the last week. It's going to catch up, sir. Mike Dowder there of MKM Partners on this economy. About 6 months ago, Vice Chair Clarida came on this show. And Tom, do you remember when he told us, we asked him, how would you know if you're wrong? When would you know? What's the timeline to understand whether you're wrong about the T word? And he said year end, at the turn of the year. And here we are, Tom, at the turn of the year, and they're making a change.
I go back to Alan, we mentioned UCLA earlier in the hour where Alan Meltzer studied before Carnegie Mellon. John, you look at the history makers in economics, Bernanke, Anna Schwartz, Alan Meltzer, Richard Timberlake, all of them. There's one constant theme that Vice Chairman Clarida studied and lives. They wait for the data. And that's exactly what they're doing.
It's better. Claims heading in the right direction. Lisa, I know you're looking at claims. Let's throw in this as well. The employment to population ratio, that's where the focus was, where they thought the juice was worth the squeeze. To wait and try and get that back to pre-pandemic levels. Will they have the patience to do that? Can they tolerate higher inflation as they try and do that through next year?
And the answer is increasingly seems to be a resounding no, they cannot be patient. I'll just note this, that continuing claims, the number of people who are receiving government benefits fell below 2 million to the lowest levels since early March 2020. So taking a look at some of these benchmarks here as far as getting back to pre-pandemic times, and it really speaks to Michael Darda's point.
Getting back to where we want to be. Coming up at the Open, we'll talk about some of these dynamics with Megan Green, Global Chief Economist at the Kroll Institute. Looking forward to that from New York City this morning. Good morning to you all. Looking forward to coverage of payrolls with you live on Bloomberg Surveillance alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Your payrolls coverage, the best payrolls coverage on the planet coming up 9 a.m. And I'm joking. It starts at 6 a.m. Eastern time tomorrow. All right, it's just a joke, Tom. It's a joke, all right? From New York, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. House Democrats have come out with a short-term spending bill to try to prevent a federal government shutdown this weekend. The bill would fund federal agencies through February the 18th and would have to pass both houses of Congress by midnight Friday. That will require cooperation from Senate Republicans who have the power to drag out the process. The OPEC Plus alliance meets today to decide whether to go ahead with modest increases in oil production. Prices have dropped more than 20% since late October, and traders expect the cartel and its allies will hold off on adding to their output. OPEC Plus is forecasting that there will be a surplus of oil in the first quarter. The Omicron variant threatens to widen an already large gap in access to coronavirus shots. Scientists are preparing for the possibility that retooled vaccines will be needed, and affluent countries are racing ahead again. Already, the UK is moving to secure messenger RNA shots tailored to Omicron and other potential variants if they are developed. And Tesla has made it official. In a filing, the electric car maker said it is moving its headquarters from California to Texas. The company's new base will be at its gigafactory in Austin. CEO Elon Musk has said that the shortage of affordable housing in the San Francisco Bay Area and long commute times were hurting Tesla's ability to expand. And the owners of Major League Baseball games have locked out their players after failing to reach a new collective bargaining agreement. For now, the lockout is mostly symbolic. Spring training doesn't start until February, and the regular season begins March 31st. Players say that salaries are not keeping up with the revenue growth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you put the garbage inside, there's a little sensor that detects the garbage and speaks out. And this is one of the initiatives that we have created here. We, as the residents of this neighborhood, a bunch of neighbors that have come together to try to deal with the fact that our neighborhood is dirty. We want to make a difference. We want to have a clean streets that look nice and are nice to walk in.
בבקשה.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Good morning, everyone. Bloomberg Surveillance. Lisa Bramwitz and Tom Keene. John Farrell getting ready for an important 9 a.m. hour on television. We'll be on radio as well at 9 a.m. We have breaking news out of Germany. This was advanced about 12 hours ago. And now Merkel and Scholz speaking. And Lisa Bramwitz, these headlines are sobering.
Yeah, the idea here that basically they're imposing curbs on unvaccinated individuals and limiting gatherings. They're aiming for 30 million vaccination shots through year end. They're talking about the hospitalization rates really pushing through limits in certain parts of Germany. And you noted it, Tom, that the very key digital conference held in Germany, in Munich, has been canceled for this year.
It is 189 miles from Munich to Davos, and this is a real important idea. Yesterday, DLD Munich was canceled for January of 2022, no doubt getting out front of Scholz and Chancellor Merkel as well. And Lisa, to me, that's the first real symbol of the log vector we see in Austria, terrible, Switzerland, somewhat like the UK, frankly, and Germany in between, and they're migrating in the wrong direction.
It's so frustrating, especially because the vaccination rate in a lot of these nations in Europe is actually better than the United States. You wonder what we have to come as we head into the winter months, and when we can just leave the pandemic era and enter something more endemic that people just deal with.
The latest headline of Bundestag to have, quote, open vote on mandatory vaccination. We have a mandatory conversation with Helene Becker, senior research analyst at Cowen, barely describes it. She has seen it all. What does it symbolize, Helene, excuse me, from Europe? And do we see those tensions of Europe come over to America economy and America aviation?
Yeah, morning, Tom. Thanks for having me. Yeah, we're really concerned about this because typically what happens in Europe gets exported to the United States with some type of a lag. And I think you're right. We are going in the wrong direction. We need to move forward. Lisa made the comment that this is endemic. We all get flu shots every year. So why wouldn't we get booster shots for the coronavirus every year? It's a flu. It's a type of flu, a bad one, admittedly. But in order to have vibrant economies, you need vibrant airline industries. And the only reason the world has been able to get as vaccinated as it has in the past 1 year has been because the airline industry, FedEx, UPS, DHL, and others have got really distributed all this vaccine that's enabled us to get to where we are. So why wouldn't we just keep moving forward and instead of moving back?
Helene, what we would and what we could and what we should do is not necessarily what is happening. And we are seeing these restrictions put back into place. We are seeing global conferences canceled like the DLD in Munich, as Tom was just mentioning. What is the potential ramification for an airline industry heavily indebted still from the pandemic, dealing with reduced capacity, reduced numbers of travelers, reduced business travel? How much of a hit are they going to take?
Yeah, I don't know the specific answer to that question because to your point about liquidity, all the airlines grabbed as much cash as they could last year. And the governments, not just the United States, but worldwide, governments supported the airline industry to the tune of $200 billion. And that money is still on balance sheet. If you look at all the U.S. airlines specifically, which is obviously my purview, you'll see that they have huge liquidity positions, 16 to 20, $21 billion of liquidity. And they weren't going to repay debt that quickly. Their goal is to keep that liquidity in case of scenarios like this where you see continued restrictions in place or where we make it difficult to travel for business because you require testing and so on. And so it makes it impractical to do a one-day trip to Europe or something like a 2-day trip to Europe, whatever. So I think that the liquidity side of the equation is fine. I think to your point about demand, we think we're seeing demand ex business traffic and international that exceeds 2019 levels. 2.4 million people were screened on Sunday, which is a pandemic record. We're clearly within 10% of where we were in 2019. So I think that's a good sign. I was at an industry event last night, and a lot of the airlines were there. Few airlines were there, and they said they haven't really seen an impact, but are expecting an impact. But they haven't seen cancellations for December yet. They're still seeing December bookings.
Elaine, just to sort of put this into cold relief, if there is another downturn in travel, if the U.S. implements some curbs similar to what we're seeing in Europe, are there airlines that will not be able to survive it?
Probably, yes. It will be tough. We don't have any sell recommendations, but we actually do have one sell as I think about it. But yeah, if we go into a downturn again, even with their massive liquidity, some one or two airlines will.
This is the gloomiest, Lisa, this is the gloomiest Helene Becker I've ever seen. Helene, let me cut to the chase. I own United Airlines at 90. You told me to get out. I didn't. I got crushed. You loaded the boat in March of 2020. Is this an opportunity to redux March of 2020 again?
Yeah, I think so. I mean, to your point about being bullish v bearish, we have, I think, 7 or 8 buys, actually. And I went out to lunch yesterday and the stocks were up, and I came back and they were down 6-7%. I do think it's a significant overreaction, and I do think there are opportunities. So, yes.
Well, thank you, Helene Becker. Thank you so much on something we all care about, which is aviation. We do this off stunning headlines out of Germany. I really wonder, Lisa, how does Austria, how does Switzerland react to what Germany does?
Well, we've already seen in Austria something similar, right? I mean, we've already seen some sort of lockdown on unvaccinated individuals, mandates to get people vaccinated. You do wonder if you get follow-ons in other places. There is a big question here. I really am curious about what the vaccination rate has to be for there to be some sort of, and I don't want to say herd immunity because I know that you'll jump on me for this, but herd immunity, some sort of prevention from transmission, because you're seeing pretty high rates of vaccination in some of these places, and still you're seeing capacity in certain hospital wings.
Dr. Hotez didn't miss a beat. I believe the statistic was above 80%, Lisa, as well. Futures up 9, NASDAQ futures a little bit red here, and the VIX showing a change in the market over the last 2-3 days. The VIX 29.72. That's not 28. That's not 25 as well. We've got much more coming up. Please stay with us for the breaking headlines out of Germany, and of course the setup as we go to the jobs day tomorrow. And of course, Bloomberg surveillance. We're on TV, we're on radio, but I really want to speak to the many years, the joy of Sirius XM channel 119. I remember going, why do we need to be on Sirius? And they just said, shut up, Tom. It's going to be great.
How often do they say that, Tom?
They put me in my place, and critically, there's like 100 gajillion people on Sirius. We're on Sirius XM, channel 119, and we say good morning to all of you. Coming up, the 12 noon hour, Dr. Bremer. Stay with us. This is Bloomberg.
esta operación definitiva para dar con la captura de este bandido la planeamos el 15 de octubre del año en curso. A las 8 de la noche en una guarnición de Bogotá, nos reunimos con los oficiales de inteligencia de la policía, nos reunimos con los oficiales de planeamiento de operaciones especiales de las fuerzas militares y de la Policía Nacional, y es cuando se decide cambiar y darle otro salto a esta estrategia.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation, and we believe that the quarter three was the quarter that was most affected.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Following the biggest two-day loss of the year so far on the S&P, from New York City, good morning, good morning. Your equity market positive, just 11 points on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
From New York, we begin with the big issue, drawing a distinction between the signal and the noise.
Jay Powell saying it's time for them to exit the market.
He knew exactly what he was doing.
This affords them maximum flexibility.
I'm in the flexibility camp as well.
This is still going to leave us in very loose monetary policy territory.
I'm not in the camp that, suddenly, he's really more hawkish.
It sounds like he's pivoting.
I just don't buy that.
I actually do. Somewhat of a conundrum for us. There's a lot of concern that the Fed is going to move too quickly.
This has become political hot potato.
That's nonsense. They're miles away from anything that looks normal.
Inflation has become some sort of, political issue.
What I want to know is what changed from Monday to Tuesday.
He absolutely, was calculating this entire move.
Well, seemingly a lot has changed this week. Wells Fargo's Chris Harvey joins us now alongside RBA's Mike Kontopoulos and Megan Green of the Kroll Institute and Harvard Kennedy School. Megan, let's begin with you. What you've learned from this week, the changes from Chairman Powell.
Well, I think Chair Powell has shown that he's doing what every good central banker does and buying himself a ton of flexibility to respond to the data. And so while Chair Powell has said we need to retire this phrase transitory, I've always said that we economists were never really intellectually honest about what transitory meant for different economists. It means different things. For me, it means inflation will be higher for another year. Now, some people might not consider that transitory, but fundamentally, I don't think the Fed's position has actually changed. If the Fed accelerates its taper, that won't have a huge significance on the markets. The monetary policy is already incredibly easy. There is a long way to go until real accommodation is withdrawn. So I think this move was expected in that Jay is buying himself a lot of flexibility.
That final point is so important. I want to build on that. We've got to do two things. We've got to talk about liftoff and then talk about how steep the rate path will be thereafter. On liftoff, the calls are in. Here they are. Barclays go with May, Goldman June, Bank of America June, Deutsche Bank June, Citi June, BNP June. See a theme here, don't you? JP Morgan September, and then all the way out to no hike from Morgan Stanley for 22, no hike from TD for 22 as well. Chris Harvey, how helpful is it to get your hands around the liftoff call without understanding how steep the rate path will be thereafter?
So John, I think we spend too much time on the rhetoric. What we need to focus on is the fact that the probability of a policy error has now dropped, and the probability of stagflation has now dropped. If you look at what's happened, the curve has flattened 40, 50 basis points in the last 2 months, 2/10. In addition to that, 10-year break-evens have come down from 275 to 240, 245. Meanwhile, reals have gone up from negative 120 to 100. What the market is telling you is the probability of an error is less. We can argue about whether the Fed is going to be bullied by the market or the Fed is doing it of their own volition. But the most important thing is the probability of stagflation is much lower, and that's a much different environment to invest in than what we're beginning to see, a more constructive environment where the Fed has control of inflation.
Let's pick up on that point. And Mike, I want your view on it. The risk of a policy error is less than it was a week ago after what we've learned from this week. Is that true from your standpoint?
You know, I do think it is true. I think what the Fed told us this week is really nothing that they hadn't already told us over the last several weeks. I mean, you had many Fed governors come out in the last couple of weeks and talk about the fact that tapering would likely accelerate at coming meetings. And listen, the market was already pricing 3 hikes for 2022 just a few weeks ago. So I'm not sure we really learned anything new with Chair Powell. Remember, he represents the committee. It's not the Jay Powell show, it's the committee show. And if the committee is saying that, listen, we may accelerate purchases, or accelerate tapering rather, then he has to represent that. And I think that's all he was making a nod to. 3 hikes next year does seem aggressive to us. I think that could end up being a policy mistake. Earnings are going to slow in the back half of 2022. The year-on-year comps are going to be harder to continue to match. And so I don't think the Fed is ultimately going to make a policy mistake. I don't think anything we heard this week would suggest that way. And I don't think that you're likely to see an uber aggressive Fed next year.
You mentioned the 3 hike call. That came from Barclays, 3 hikes for 22. They start in May. That's the call from Barclays and Mike Gapin. They look for 4 in 2023. And to Mike's point, this is a committee story. It's not just Fed Chair Jay Powell. Take a listen to what the Cleveland Fed President, Loretta Mester, had to say.
Right now, with the inflation data the way it is and with the job market as strong as it is in many dimensions, I do think that, we have to be in a position that if we need to raise rates, a couple of times next year, we're able to do that. So again, quickening the tapering gives us that optionality.
We've got to build in some flexibility, some optionality. Megan, is that what you heard this week as well? Not necessarily charting a course towards rate hikes anytime soon, but building in the flexibility to move if they have to.
Absolutely, particularly given we've had a new variant emerge just before Jay Powell's speech, which Jay had argued would create uncertainty around our inflation forecast. He highlighted that it could cause people to stop going to work, and that would exacerbate the labor supply shortage, and that would be inflationary. But it's just as likely, actually, that the opposite happens with this virus. We have no idea. We just don't have the data yet. But if this variant becomes dominant and actually evades vaccines, we could see what we saw back in early 2020, where people stop going out regardless of government restrictions and just stop going out and spending. If going to the bar will land you in the hospital, no one's going to do it, in which case demand will fall off significantly. And that would be disinflationary. There's so much uncertainty around this in terms of the impacts on inflation that I think Jay Powell has to have maximum optionality for what the Fed's going to do based on the data that comes in.
Couldn't agree more. We've got no idea, especially when it comes to this variant. The 3 things I keep drilling home on that we still don't know. How contagious is the new variant? How effective are the vaccines against it? How severe is the disease? We won't know maybe for a few more weeks. One thing we do know is this market's on the move. Equity futures fade a little bit. The S&P 500 now unchanged, and crude taking a dive. With the headlines on oil, here's Abby.
Yeah, John, we have a headline crossing the Bloomberg terminal right now that OPEC Plus, Russia has said to propose that OPEC Plus propose an output hike. This is not entirely surprising because, of course, not so long ago when the Biden administration decided to release reserves, U.S. reserves, there was thought that OPEC Plus would fight that by also releasing more supply. So there is this now headline, Russia said to propose an OPEC Plus output hike. On this, we have oil absolutely plunging on the day, down 3.4%. And now for the quarter, this is really interesting because, of course, we've had this weakness going back for many weeks now, the month of November, the worst month for oil since March of 2020, perhaps in anticipation of this. And on the quarter, it is also right now, this fourth quarter of 2021, right now, the worst quarter since March of 2020. That's the degree of selling power that we have, down 16% in the quarter. And this headline not helping the idea of more supply.
Not at all. Abby, thank you. 63.83 on WTI. Let's call it 63.80 as it jumps around. We're negative 2.9%. Crude on a $20 round trip over the last month or so. Mike, can I get your view on this, the move in energy, how you pair that with your views in the fixed income market on treasuries at the moment?
Yeah, Jonathan, I think one of the big things, and I'll get to treasuries in just a moment, but one of the things that no one's really talking about right now, and Megan kind of alluded to this with respect to the variant, and could that bring us back to 2020 type levels? Well, you know, credit spreads have widened a ton. And that's the sign that, you know, we think needs to be paid attention to. It's actually credit has underperformed the equity markets. We think this is overdone. We think it's a fabulous opportunity in corporate credit, particularly in the U.S. But clearly credit markets are saying there is some stress here. And remember, the Fed and Chair Powell, this is why they provide stimulus to the economy, right? This is why they loosen financial conditions. It's to provide support to credit markets. And so going back to the previous conversation, you know, at the end of the day, the Fed's not going to let credit markets widen too much. Energy falling, treasuries obviously have been kind of skittish with respect to the front end going up and the back end kind of staying put, if not going down. The curve is flattened a ton. I mean, the market's clearly saying, right, the Fed is going to rein in inflation at the expense of growth. Now, whether that's right or not, we'll ultimately have to see. And I think we'll get clues from the credit market whether or not, you know, that's the correct assessment.
What you just said about credit echoes of what Bob Michael at JP Morgan Asset Management said to us yesterday. You sell government bonds, you buy credit. There's a lot of concern that the Fed is going to move too quickly for the market and will lead to recession. That's nonsense. They are miles away from anything that looks normal. Megan Green, you alluded to that, and I want to build on it. This word normal gets thrown around. I have no idea what normal is after we've had 10 years plus of deeply, deeply negative real rates in some places in Europe. We've still got negative nominal rates. And Megan, I wonder from your perspective, how much work would need to be done to even take a bite out of the accommodation of what the Fed is delivering right now?
Yeah, so we know that the risk-free rate is lower than it was 15 years ago. How much lower is a matter of interpretation, more an art than a science. But, you know, I think the Fed would have to get rates up over 1.5% in order to feel that we were normal. That's a long way from where we are now, particularly if you consider tapering has to happen first. I should highlight, I don't think that the Fed's going to get rates up back to previously normal levels. So 3%, for example, 4%. I just don't think they can without undermining their unofficial mandate of financial stability. I think most of the good news is priced into markets, certainly was up until a week ago, for example. And in terms of credit markets, everything looks pretty good because companies are sitting on tons of cash, liquidity is easy, profits are great, but there all the good news is also priced in. And so as profits start to come off, I think that credit markets will look scarier. And it's worth pointing out that most economists thought that leverage in the corporate sector were going to cause the next recession. We didn't know it would be caused by a pandemic. Yep. But that's just been turbocharged. So I think there are worries there, and the Fed can only get rates up so far before sparking that.
Chris, I want your final view on that before we move on to other things. But the signal you take from credit right now, what is it, Chris?
So what we think is happening in credit markets, it's just a natural repricing of risk. Credit was very, very tight. And if you look at when credit started to get wide, it got wider in and around the peaks on inflation. So what it was saying is we're worried about stagflation. Now, it hasn't come back yet, but our team thinks that it should start to tighten up. At the end of the day, we do have good fundamentals. We do have a lot of cash on the balance sheet, and we do have a situation where it does look like stagflation is not going to be the primary issue. So we're not too worried about credit at this point in time. But certainly it is a risk factor, and it is something that we watch.
Chris Harvey, Mike Kontopoulos, Megan Green, sticking with us. Coming up on the program, the Omicron variant hitting U.S. shores.
We knew that it was just a matter of time before the first case of Omicron would be detected in the United States. We know what we need to do to protect people, get vaccinated.
We head to Washington next from New York. This is Bloomberg.
An extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal, but Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of health care, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This new variant is a cause for concern, but not a cause for panic. We have the best vaccines in the world, the best medicines, the best scientists. We're learning more every single day, and we'll fight this variant with science and speed, not chaos and confusion.
The president reassuring the nation about its fight against the Omicron variant. National Economic Council Director Brad Deese saying it's too early to gauge the economic fallout.
It's too early to know precisely the impact economically. We need to learn more about the transmissibility and the severity of this variant.
In the meantime, the president preparing to lay out additional protections this afternoon, with the White House writing, quote, "These actions will help keep our economy growing and keep Americans safe from severe COVID-19. For more down in D.C., here's Joe Matthew. Morning, Joe.
Good morning, sir. We do expect to hear from the president a little bit later on today. He'll travel to the National Institutes of Health to speak about this. And we do, Jonathan, have to acknowledge how little we know, as Brian Deese said, and I would applaud your caution in the way that we've been handling this. It's going to be a couple of weeks before we get real data on this. So that's the backdrop for this speech today by the president, recalling the old line, you go to war with the army you have. As far as what we know here, what the president will talk about, some of which we discussed yesterday, increased testing for those coming in from outside of the country. Likely a negative test result will have to be shown within a day of getting on an airplane. There could be a follow-up test once people get here, and a possible quarantine as well, for that matter. Masking is an issue. We're going back through the greatest hits here. Masking, a mandate will be extended into mid-March for planes, trains, and other federal properties where we have common spaces. And as well with testing, the president will urge private insurers, it's expected, Jonathan, to cover the cost of at-home tests here. Now, I have to say, speeches like these have become a hallmark of this presidency. He described the dark tunnel around this time last year as we headed into the winter surge. And of course, we're coming into the holiday period here as well. We were also, remember, Joe Biden saying we were close to declaring independence from COVID around the 4th of July, Jonathan. And then we had the 6-point plan to deal with Delta back in September. So we can assume that today, Jonathan, will not be the last one of these.
Totally unpredictable. We need some humility going forward, as always. Joe, fantastic to catch up with you. Look out for Joe Matthew on Bloomberg Radio Sound On, weekdays at 5 p.m. Eastern Time. They are the moves lined up from the American administration. Here are the moves lined up over in Germany. Germany cracking down on the unvaccinated, with Angela Merkel imposing new restrictions in one of her final acts as Chancellor. The outgoing Health Minister saying the following: the important thing is that it's virtually a lockdown for the unvaccinated. The more than 12 million adults who aren't inoculated is what is creating a challenge for the health system. Mike McKee, Germany going in hard in the last 24 hours.
Yeah, I would imagine Joe Biden would like to have the ability to do what the Germans are doing. The combination of Angela Merkel and Olaf Scholz, they met, and here's what they decided on. One of the strictest, not lockdown, but the strictest attacks on the virus that we have seen in recent weeks. You can see Germany has a problem because they are having a huge wave of the COVID cases from Delta, and now you've got Omicron out there. So what are they going to do about it? As Jens Spahn said, they are going to, at this point, limit the ability of unvaccinated people to go to restaurants and theaters. Only vaccinated people, or if you've recovered from COVID, can go. Can't go to the non-essential stores. They are going to limit the number of people who are allowed at football games, soccer for you Americans. I said football for John. And they're going to close they're going to close nightclubs in places with high infection rates. But the big thing that they're going to do is impose a vaccine mandate. Joe Biden tried to do that. That's tied up in the courts here, but they're going to have the Bundestag, the parliament, vote on it this week. And if it's approved, everyone is going to be required to get a shot. They're going to increase the pool of people who can administer the vaccines to try to make that happen. Angela Merkel says 30 million doses by the end of the year is their goal.
That's the goal. Mike McKee, we'll catch up with you later on payrolls. Looking forward to tomorrow. There are still so many things we don't know. And over the last week or so, you've seen the knee-jerk conclusions, people speaking with conviction. Rely on the process. There are 3 things we need answers to, 3 things we don't have answers to. Here are the questions. How severe is this variant? How effective are the vaccines against it? And then you've got to think about how contagious it is after that. Until we get the data to answer those questions, we can't draw big conclusions. It could be bad, it might be okay. This was JP Morgan's Marko Kolanovic on that. He writes the following: Omicron could be a catalyst for steepening the yield curve, a rotation from growth to value, a sell-off in COVID and lockdown beneficiaries, and a rally in reopening themes. Back with us, Chris Harvey, Mike Kontopoulos, Megan Green. Megan, the range of outcomes off the back of this variant, they are very wide, aren't they?
They are. I don't hear anyone arguing that this variant could be a boost to growth in the short term. So if anything, we know it will probably drag on growth in the short term. It's a different story in the medium to long term. It's the impact on inflation that's entirely uncertain. And as I mentioned, Chair Powell in his comments to Congress highlighted that it could be inflationary. And that's right if the supply shock outweighs the demand shock. But the opposite could easily be true, in which case it could be disinflationary. And so the Fed and every other major central bank meeting that same week of December 15th, the ECB, the Bank of England, the Bank of Japan, they're all going to need to be willing to adapt to the information that we find out over the next couple of weeks.
What a 24 hours that will be. The 15th, the Fed, the 16th, the Bank of England and the ECB. Mike, I want to come to you on that call from Marko Kolanovic. We could be seeing steeper curves. 2s10s right now, 82. Where are you on that, Mike?
The flattening that we've seen is, to us seems overdone, quite frankly. We would agree with Marko, and in fact agree with most of his statement as well, that, listen, you gotta look at the data, right, Jonathan? You just said it. We don't know what the data is going to be for Omicron, but what we do know is we know that the Fed is likely to support and continue to support recovery. If Omicron gets worse, the Fed is going to be there to support the markets and to support the economy. We know profits are still strong, right? We know that sentiment and valuation and some areas of the market, like tech and growth, are quite high, and other areas of the market, like value, are quite weak. And so when we sit back and we look at the flattening of the yield curve and what that suggests, that the Fed is going to be very aggressive into what could be, we don't know, but what could be a slowdown because of Omicron. Yet the data suggests still, look at continuing claims this morning, look at profits, the data still suggests that the curve should be steeper, that the economy, that the recovery is intact, and that value should be doing well. And so we would agree with Marko in this sense. The curve is likely supposed to be closer to 100 basis points, not 80 basis points, and value likely outperforms growth, and credit looks pretty good.
The ISM was decent. yesterday as well. The ISM was really strong. We'll talk about that a little bit later. Chris Harvey, final word on this. A theme of what Mike just said there was that you can still depend on the Fed to support things. Can you, Chris? Can you depend on them? Is that Fed put still durable into next year with inflation looking like it is?
John, that's a great question, and I really applaud you for what you were saying before, because we don't know. We're speculating on a lot of speculation. But to get to the question, what I believe the Fed will do is, if things get worse, or that the virus does break out and it affects the economy, they'll slow down their rhetoric. So will they put some support there? Yes. How much support? That's hard to say. Is there a real put? At some point, yes, but that put's probably a lot lower than we're traditionally used to. So I do think that they will modify, or they will talk about the economy and the relation to the variant, and we should see some support for it, but don't expect a ton of support.
We'll keep working on this. Chris Harvey, Mike Contopoulos, Megan Green sticking with us. A move in the oil market. We're down 2.6% on WTI. On Brent, we're down by 2.4 to a 67 handle on Brent. Here's the headline: OPEC Plus agreeing to proceed with that January output hike. That according to delegates and our reporting here at Bloomberg. More still to come on that and your morning calls from New York City. This is Bloomberg.
represent 5,500 forecourts, which is roughly 65% of all service stations in the UK. Of the ones that we were able to survey yesterday, roughly 1,500, 27% said they didn't have any fuel, 21% said that they had one fuel type or another, so that's either petrol or diesel, and 52% said that they were fully stocked. Northern Ireland, Wales, Scotland seems to be okay, so we still are seeing, like your reporters are seeing, some stock outs at sites around London and the South East, I'm afraid.
When do you feel confident that this will 100% be in the rearview mirror?
Well, what we're hoping is those people that got fuel over the last few days obviously don't need it again for another few days, and that will give us a chance to actually start to restock the network. So we're trying to get it back to a reasonable level today and tomorrow, and then over the coming weeks, because it will take a number of weeks, to get it back to the sort of more normal running levels.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Minutes away from the opening bell in New York City this morning. Good morning. This bounce is fading. Equity futures on the S&P up just 2, advancing 0.05%. On the Nasdaq, we're negative 29 and down 0.2%. The cash open just around the corner. Let's get you some morning calls quickly. First up, UBS calling Amazon its favorite name in US e-commerce, seeing multiple levers driving margins and growth next year. Wolf Research downgrading Ford to peer perform. The analyst highlighting the stock's unfavorable risk reward, with auto suppliers offering more upside. And finally, Piper Sandler cutting its Twitter price target to 54, seeing a challenging macro environment and overly optimistic growth targets. We're up there by just 0.4%. Coming up, a red flag from America's tech giant. Apple warning suppliers of slowing demand ahead of the holiday season. 159.55 on Apple. We're negative 3%. Your opening bell this Thursday morning, just around the corner. From New York this morning, good morning.
you put the garbage inside, there's a little sensor that detects the garbage and speaks out. And this is one of the initiatives that we have created here. We, as the residents of this neighborhood, a bunch of neighbors that have come together to try to deal with the fact that our neighborhood is dirty. We want to make a difference. We want to have a clean streets that look nice and are nice to walk in.
בבקשה.
People are talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did
I
he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
The October jobs report beat expectations for job creation.
We're experiencing the strongest economic recovery in the world.
Will we get another great jobs report for the holidays? Find out Friday on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. 23 seconds away from the opening bell in New York City this morning. Good morning. Coming off the back of the biggest two-day loss on the S&P 500 on the year so far and struggling to find a bounce on the S&P. We're up just 2 now, positive 0.04% on the S&P 500, positive on the Russell, negative on the NASDAQ by a third of 1%. That's the opening bell. Switch on the board and get to the bond market. Your 10-year Treasury yield looks a little something like this. Yields up just a basis point now on 10s. We've seen some real flattening come through, led by not what's just happening at the long end, but also from what's happening at the front end as yields start to build up again on 2s. That's the bond market, 141.38 on 10s. In the FX market, euro dollar 113.41, appreciating there by 0.2%. Crude rolling over, though off session lows, taking a dive over the last couple of minutes as OPEC looks to push forward with an output increase, 64.46 on WTI. A few things we need to look at around the opening bell. A fairly flat open about 30 seconds in. We're negative just 0.05%. Information technology leading the declines here, down by 1 full percentage point. Topping the gains, financials up by 0.8%. And the big mover we need to look at is Apple. In early trading, your first price, looking at Apple right now, is negative 3.5%. Apple and its suppliers falling on some reporting from the team here at Bloomberg saying the following. The company has told its component suppliers that demand for the iPhone 13 lineup has weakened. With more, here's Abby.
Yeah, John, this is pretty interesting because, of course, yesterday Apple hit a new all-time high even as the market was plunging. So this bad news that has come out today, or this less constructive news, really hitting shares, the worst day since May. That's the degree of the selling power. But as you mentioned, our colleagues, a Bloomberg exclusive reporting that Apple told its suppliers that there's less demand for the highly anticipated, or that iPhone 13 that I actually saw last night at a phone store myself. Very beautiful, but this is a part of the trend that we've seen recently. Back in 2018, the iPhone was 69% of their holiday quarter revenue. That fell to about 62% in 2019, and now it's expected to be less than 60%. They have cut the production by 10 million units to 80 million over supply issues, but they do believe that the demand is less. But they're expecting, however, record revenues, so that difference will be made up perhaps by other products such as services or, say, the iPhone watch. However, you can see that the suppliers are down, not plunging though, John. This is not fearful trading, so to some degree priced into these stocks. However, again, Apple yesterday an all-time high, and that means that Apple has not been correlated so much to the S&P 500. You can see here in the top panel in white, Apple much higher than the S&P 500 in blue, the correlation going negative. It's hard to know what this is going to mean going forward, though, given the weighting for Apple to the indexes. Right now, those indexes about flat, so it seems like maybe that correlation is going to remain negative and indexes not taking the cues from Apple, as has been the case more recently, John.
Abby, thank you. Apple negative in early trading. Back with us, Chris Harvey, Mike Contopoulos, Megan Green. Megan, is this a decent example of how supply issues can hurt demand? If you don't believe you're going to get the product anytime soon, why buy it?
Yeah, so economists like to discern between supply and demand like they're completely independent things, but of course they're not. One can always influence the other, and this is an example of supply influencing demand. People may not be willing to wait for those Christmas gifts. People also, given that inflation's rising higher than wages, might not want to spend $1,000 on a phone this year. So I think you are right. We are looking at the circularity of supply and demand here.
And trying to work out these issues. Morgan Stanley rated the following on their rate call and the risks around it. They said this: policy remains data dependent, and if supply, both goods and labor, remains constrained for longer and inflation remains elevated at the same time, we see hawkish risk to the policy path. Now, Mike, let me come to you on that. The constraints around labor, the constraints around goods. Any early signs that that's healing from your standpoint?
Well, at the end of the day, yeah, I mean, we're definitely seeing constraints on both sides, right? Labor and goods, and I think that's one of the reasons why inflation is likely to last longer than most expect and be higher than most expect. But the question becomes, and this is really difficult for the Fed, and Chair Powell has said it a number of times over the last week, is you have a dual mandate. You have inflation and you have employment. And at the end of the day, we believe that the key risk that the Fed is most concerned about is maximum employment. And so, yes, we do think that the labor constraints and the product constraints that exist are real. We think that they're going to continue to contribute to inflation that lasts, for some time. But you're likely to also see it come down. I mean, 6% inflation, 5% inflation on a year-over-year basis is not going to persist as the comps get harder. But you are going to start to see the shift into more permanent areas of the market, like wages, to bring people back. And as that happens, the supply side should start to relieve itself. You get inflationary pressures go down on the supply side, but you get them to go up on the wage side, at least temporarily.
And that would be at least a sign, a symptom of a better economy in America. We saw a hint of this in the ISM yesterday. Prices paid in that component came in a little bit. I was looking at some of the commentary, and here was a quote that stood out for me. The U.S. manufacturing sector remains in a demand-driven, supply chain constrained environment with some indications of slight labor and supplier delivery improvement. I want to talk about that delivery right now with you, that improvement, Chris, on the delivery side of things and beyond. The White House and Brian Deese put out this tweet recently, and they've started to put out this supply chain dashboard, and it's pretty interesting. If you look at the imports arriving at ports, that is up by some 16% over the last year or so. If you look at long-dwelling containers, these are containers sitting on the dock for 9 days or more, they're down 41% since November 1st. There are some signs out there, Chris, if you look, that things are getting better slowly.
Yeah, John, let me shift gears a little bit and let me talk about pricing. And more importantly, one of the things we've talked about in the past is the consumer is a price taker and has been a price taker. Raise price, I'll take 2. Doesn't matter whatever price you raised it to, people didn't care. Now, maybe what we're beginning to see is the consumer cares. And that's really, really important, because what we've been thinking, what we've been talking about is companies have pricing power. Well, if they don't have the same pricing power over the next 6 to 12 months that they had over the last 6 to 12 months, then multiples have to change. Furthermore, we need to talk about inflation and whether that move in break evens is really just that.
Yeah,
we don't know. We're getting that kind of anecdotally, and maybe that's what's occurring. Part of this is kind of clouded because there was a mad dash for products and goods before the holiday season because everyone knew that there was short supply. But maybe that's exactly what we're beginning to see. As far as the supply chain is it's very hard to tell. Depending on where you're standing, things are improving, things aren't improving. But at the end of the day, I think the more important issue, the more impactful issue, and the thing you really have to focus on is the consumer still that same price taker he or she was 6 and 12 months ago? And the answer is beginning to be probably not.
What are the investor implications of that, Chris? Let's get to the heart of your call right now. You were looking for that short-term melt up in the equity market into year-end and then that fade through next year. Walk me through your thinking at the moment.
Yeah, and that's part of our fade for next year, because if you don't have the same kind of pricing power going forward as you did over the last 6 to 12 months, multiples will compress. We still think earnings go higher, but the issue we're going to be finding is multiple compression as the Fed changes as growth decelerates and perhaps as we don't have the same pricing power. And so we don't think it's a short-term issue. It's not a today, tomorrow issue, but it's a big issue in 2022, and it's likely one of the issues that's going to cause multiple compression.
Chris Harvey, that's the call from Wells Fargo. Chris, it's great to catch up, sir, as always, alongside Mike Contopoulos and Megan Green. In the crude market, that's where the focus is for me and for our audience right now as we take a little bit of a dive on WTI and on Brent. Brent crude down by 1.2%, WTI down by 1.27% to 64.30 as we look for an agreement at OPEC Plus to deliver more crude into next year. That's coming up next from New York. This is Bloomberg.
Happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Years ago, Ewan Dixon was the first guy to do it. It's taken a century for us to change our propulsion system away from liquid fuels.
There are dozens of international companies in that airframe size who have realised the opportunity, are in a race to get those commercial aircraft out there at that scale. It's an area that can be served by hydrogen, which we're well placed with, through fuel cells.
market for oil ultimately creates this volatility kind of paralysis, which is, you know what, I don't want to go on holiday and come back and oil's down 30%. This is just too high octane for me. And so with that in mind, I think that being able to put a floor on price is important. Ultimately, that's OPEC's role in some ways. But equally, the geopolitics of oil can often sort of get in the way.
OPEC Plus agreeing to proceed with a January production hike. Brent taking a leg lower off the back of that, heading for a third consecutive day of declines. We are lucky, fortunate to have Bloomberg's Will Kennedy in a studio in New York City with us today. Will, what's the latest on this one?
This is a surprising outcome to the meeting, actually, going into today's deliberations. Most people expected that the new variant would mean that OPEC decided to hit the pause button and not go ahead with this hike. When it's come to it, they've gone ahead, and I think it's quite a bearish outcome to the meeting. It's caught a lot of traders by surprise. What do we read into it? A couple of things. I think that they're clearly taking a bet that the initial overreaction to the new virus strain may have been an overreaction and that there won't be a big hit to demand. And I think the other thing that's interesting is it may signal some lessening in tension that we've seen between Washington and Riyadh over the whole oil market that led to the SPR release last month and some very hot rhetoric from Saudi officials in return. I think it's a sign that some of the heat may have come out of that conflict. The only other thing I would note, John, is that there is some wiggle room in the communique that we've seen, which says they give themselves their right to change their mind at any time over the next month if the impact of the new virus strain is worse than they're hoping.
They sound like central bankers now. We heard from JP Morgan very briefly with this massive call which I'm sure you've seen. 150 on Brent in 2023, 125 in 22. And there's a distance between them and the market at the moment on OPEC spare capacity. JP Morgan says it's 2 million. Consensus estimates say it's 4.8 million. What's your read on that? How much wiggle room they actually have, how much spare capacity they have to deliver to this market, Will?
I mean, setting aside those price calls, I think that the bank raises a very important point, John, is that people are very worried about how much spare capacity there is from OPEC. What you see with OPEC is they raise 400,000 every month in theory, but a lot of countries are unable to meet their part of that. And the only people really putting extra oil into the market or able to put extra oil into the market are Saudi Arabia, the United Arab Emirates, and to some extent, Iraq. And I think that will become more and more into focus as demand continues, if demand continues to recover, as demand continues to recover. And I think that's going to be a big talking point for the market next year. I agree.
Will, it's been too long. It's good to see you, buddy. As always, Will Kennedy there of Bloomberg. Looking at the move in crude, we're down by 1.3% to 64.77. If you want to move in the FX market, look to Turkey. The Turkish lira resuming its move lower, dollar lira positive. The move over just 4 days, almost 10 percentage points. And President Erdogan again shaking things up, dismissing the country's finance minister, removing yet another critic of his aggressive interest rate cuts. Joining us now in the latest, Damien Sassa. Morning, Damien.
Morning, Jonathan. Yep, that's exactly right. The revolving door amid policy officials inside Turkey continues. The finance minister has been on the job for less than a year. He objected to the most recent 100 bip cut to 15% by the Turkish central bank. And so he's no longer in that position. And so he's been replaced by, the deputy finance minister who has some allegiance to Berat Albayrak, the son-in-law for Erdogan. And so, look, credibility is all but shot. I think the risk here is how much do we see contagion spilling over into the European banking sector? And there are really 5 banks that are most exposed to Turkey, Jonathan. We know who they are. They're HSBC, ING, BBVA, Unicredit. And so, of those, BBVA flags as, the most exposed. But look, if you just look at, foreign bank claims on Turkey, they're down considerably, 30% since 2018 to 142 billion. So we do believe the potential for contagion is relatively limited here.
Damien, just a final question from me, and you touched on this earlier this morning. I think it's important. Who's left in this market trading the Turkish lira, with dollar lira going from a 6 handle earlier this year to a 13-1?
Well, it is the banks, Jonathan. I mean, they're the ones who have to hedge that risk. They have to hedge that exposure. They need to use derivative instruments and the like to do it. But those derivative instruments are becoming increasingly expensive. If you look at 1 month, 25 delta risk reversals, they're trading at an all-time high. And we said it earlier, nobody really cares. You can't take advantage of that skew because really, it's just become too prohibitive to do so. So, from where I sit, the real exposure is going to be in Turkish dollar credit. There's quite a bit of Turkish dollar bonds outstanding. And so, yeah, we're looking at CDS spreads here in the U.S. They're at 550 bips and widening, sir.
What a move. Damien, thank you, sir. I'm exhausted. I'm sure you are too, following this country and this FX market too. Damien Sassa there of Bloomberg Intelligence. Dollar lira, 13.50, a move of almost 2 percentage points. For the broader equity market, 26 minutes in, or rather, almost 20 minutes in. Equities advanced 0.7%. Your sector price action now with Kriti Gupta.
Well, good morning, John. You have financials, consumer discretionary leading the broader index higher. And of course, a broad rally, but really your laggards here are going to be tech. Under the hood, it's your Amazons, your Teslas that's really driving those gains. Like you said, Apple suppliers weighing on the index. But towards the top, you also have industrials as well. And a big chunk of that is going to be Boeing, coming up about 5.2%, rallying rallying this morning and just early trading. Boeing getting an airworthiness directive from China, getting it one step closer to that ungrounding, also getting an upbeat outlook from its engine supplier Safran, and bonus on top of it in talks with India's jet supplier. This is huge news for the aerospace company or industry, I should say, John, because as you can see year to date, it hasn't been doing a ton of really movement as you kind of get this tug of war. Will they or won't they invest more in the aerospace sector?
Critty, great work as always. The name that Critty's been on top of through the morning is Apple. Just to give you an update on that, that stock is negative 2.5%, down 2.4%, about 17 or 18 minutes into the session. This off the back of our reporting here at Bloomberg that the company has told its component suppliers that demand for the iPhone 13 lineup has weakened, according to people familiar with the matter. Going into the holiday season, that stock is lower, on a session at least, by 2.5%. This time tomorrow, we'll be talking about one thing, at least I think we will. It'll be payrolls. Payrolls Friday just around the corner. Your estimate, something in and around 500. Let's call it 546. The range, though, Mike McKee, let's talk about that range. The high, 800K. The low, 375.
Yeah, this is more of a checklist kind of a report for the Fed rather than something that is going to make a huge difference in their policies. But they could be impressed if the market, if the numbers do what they're expected to do. Payrolls, they just want to see them, as you said, rising 400 to 600,000 a month, and the trend keep going. The participation rate, though, they want that to rise so more people come into the labor force. Unemployment has to keep falling, especially for minorities. And average hourly earnings they'd like to see rising, but at a slower pace, and that may be affected by the participation rates because people have not been coming back into the labor force as much as needed given the number of job openings, and that's been particularly true for older workers. You look at the participation rates out there, and they're pretty low. They're nowhere near where we were when the pandemic started. You can see only the youngest workers have come back, and a lot of the older workers still hanging out, waiting. And that's a problem because if that continues, then companies have to pay more. And there is a correlation you can see between unemployment and inflation. It has been rising because unemployment has been going down. We're expecting that. It's a normal kind of correlation, but the difference between those two is quite wide, the widest it's been in quite some time. So a lot for the Fed to watch tomorrow, but we'll see if it's more about the trend than anything else.
Mike, the thing that stands out for me, for us, for a lot of people over the last year has been the chart that the Federal Reserve pointed towards, and Secretary Yellen too, the employment to population ratio, which you've just alluded to looking at participation. We're back to 58.8. Before this pandemic, we had a 61 handle, 61.1. Now, I'm trying to understand from the communication we've had this week, what's your understanding of that, Mike? Have we given up on trying to do better there? Have we given up on getting that back to where it was?
Well, the Fed has not, which is sort of the pivot point for their decision making. They think that inflation will come down next year in part because more people will come back into the labor force, that they've been delayed by fear of COVID, and that could be delayed now by the Omicron variant as well. And they think it's also because people are maybe not anxious to go back to work as long as they've got some money in the bank. That'll change, and then they expect people to come back in and start taking up jobs, and that will hold wages down. But that's their bet. We don't know what's going to happen.
Final comment on payrolls, Mike. I've been grappling with this all week. Are we de-emphasizing the payrolls report because of Omicron? Does it matter ahead of December 15th for the Federal Reserve? How important is this print that comes tomorrow morning at 8:30 Eastern Time?
Well, Omicron really doesn't impact this because it was discovered after the,
of course,
well after the survey. It'll be what happens with that going forward. For the December 15th meeting, this is, as I say, more of a check the box. If we meet the tests that the Fed has set going forward, then they can move on to worry about inflation, and that'll probably lead them to do the faster taper. If we get some sort of really weird low number, though, that could lead the Fed to back off.
Mike, I asked this question at the start of the week. Let's finish there and end the week with this question as well. If Chairman Powell could take one thing right now, this jobs report or the efficacy data and the data we want around the Omicron variant, which one would he go for right now?
Depends on what he's trying to do. If he wants to make a decision on the 15th, he's going to take the inflation data and the jobs data that goes along with it. But looking into 2022, he'd probably like the efficacy data, know what's going to happen with Omicron.
That's what we all want right now, Mike, and we don't have it. We're going to have to wait a few more weeks, and maybe we might not have it by the time we get to December 15th. Maybe. I hope that's not the case. Mike McKee, thank you, sir. Your equity market with a lift. We do have a lift now, up by 1% on the S&P 500, up by 46, about 22 minutes into the session. Coming up on the program, the market-moving events you need to be watching. That'll be next in our trading diary from New York City. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
"25 minutes into the session, here's your bounce. Biggest two-day loss on the S&P 500 for the year so far, bouncing back about 1 percentage point on the S&P 500. Really difficult right now to draw a distinction between the noise and the signal. The news and the noise as we try and work out what's really driving things. The variant, the Federal Reserve, or the fact that we're up more than 20% on the year so far on the S&P 500 going into year-end. And as Jens Nordvig of Isante pointed out, maybe just some risk management going into year-end. And you look at the price action, you always look for that line back to fundamentals. Perhaps right now, it ain't there, at least all the time. Switch up the board and get to the bond market. 2s, 10s, and 30s. Big discussion on what the Fed will do, won't do. There is a consensus right now for liftoff, at least for 2022. It's in the summer. Barclays in May, a whole group of banks in the month of June, and then Morgan Stanley way out. Q1 23, TD even further out, back end of 23. We'll see. The front end of the curve, though, is still short of the highs of the year from where we were last week at 65, right now at 60, but the curve is flatter. 79 basis points to end last year, right now 83. It's just done this over the last 12 months. That's the bond market, that's the price section. Let's get to the trading diary. A host of Fed speaks still ahead, with Quarles, Bostic, Daly, Barkin speaking through the day. President Biden addressing the Omicron variant at 1:40 Eastern. St. Louis Fed President Jim Bullard speaking on Friday, plus wrapping up the week with payrolls. And finally looking ahead to another CPI print coming next week. Looking forward to full coverage of the payrolls report with an all-star lineup, as always, on this program. Rick Reeder, Mohamed Al-Arian, the likes of Anastasia Amoroso and Mike Collins, too. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
what do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also, we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself.
So ¿dónde vive acá? En la parte de...
This is not a job. If you do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansathi.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansathi.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was